Abdul Shabazz, and this is some real change stock options trading journey. And today, this terrific Tuesday, so grateful for you guys to be here. I salute you and thank you. Getting my plans ready right now. Getting my plans ready right now. Market has gapped back up above the 745. Back above this white line that I have. This white line that I have at the 745 represents monthly control. Talking about a top-down analysis, we started from the month, then seeing what's happening this week, then on the daily. Right now, being back up at the 745, the market is giving up half of the move it made downward yesterday, getting all the way down to 741 yesterday, but now currently trading at 745, a nice gap up. We called out this beautiful move yesterday, and I still like it for today as well. But I'm going to be interested a little bit more in that 743 area. Seeing if the market decides to hover in that area. But right now, the bulls are taking control of the market. Pre-market, that is. Still got a little time before the market opens. So I'm just getting together my plans. What I'm thinking about. If this holds, fine. I'll come up with a call. If it doesn't hold, I'm liking that 743 for an entry area. So for me, I'm going to put an alarm to alert me at the 743. Okay. And then I believe we can take that to sheer profits to the 741.7. After that, I do not know. It's okay to use half and whole numbers. So for the day, I do not know a secondary profit target beyond that 747.
Hey guys,
This.
Descendants Wicked Wonderland is taking you on a journey down the rabbit hole. We're gonna defeat Maddox. You gotta think like a villain. Now available on Disney Channel and Disney Plus. DisneyPlus.com/whatstash-on.
Team in the building. What it do? Jesse Swanson. Let's get it. Quiet Soul. What it do? Team in the building. Yes, sir. All right, just coming up with a game plan, guys. Looking at potential calls and puts for today. The market has gapped up $4 from the low that it reached yesterday. Post-market, it reached a low of 741. Pull that up here. Let's talk about it. Post market, it got down to 741. Okay. Tagging both our levels great. There was that beautiful break and retest I told you I was looking for. So this move that I called out happened at 2:30 yesterday. And you could have gotten in at the 745 and taken it all the way to the 741.7. That move today, I wouldn't be interested until she started hovering with a break and retest of the 743 area, and then I will still take that down from the 743 possibly down to the 741.7. That's the next level. Additionally, however, this teal line that I have here that the market almost came down to represents the natural sweep area for the week, and the bulls have stepped in and have bought up and have done so post and pre-market. They're still allowing it to hold up above the 745, which means at this point the market is still green for the month. Below the 745 we're red for the month, but even more so we would then start backpedaling with a lot of this momentum that was gained post-market and pre-market. Again, this is a $4 jump from the low of 741, and it actually went to 746.7, okay, to be exact. Right now it's currently trading at 745.5, and that's still a $4 jump, but it went all the way to 746, okay? And it happened in this sweep area. Nothing is exact, but that's exactly why I had this teal line here, and it just so happened to take place when we can't trade. No problemo. Now, as far as to the upside, I still don't know yet. I'm still not convinced just yet. There is a level, but I haven't got to that convincing level yet. Let me go ahead and come over here, see what we're looking like here. Okay. I still like that. Let's slide this over. I still like that. Knowing we're going to come down to the 741.7 area and bounce from that area. And that's exactly what we have done. But we have not come back down as I thought or have anticipated. We haven't done it. We haven't come back down yet. However, I still like this area. And I guess I'm going to have to say I like that 746 area for a call. Getting above that 746.7 area. So let's go ahead and put that there. That's going to be the 746. I like that 746.7 area. And what could we take that to? 749. I'll call that a win if we can do that. Okay. So chart still intact. Just had to scoot everything over, that's all. But I still like this area, 746.7 for a call. If the market can get there, there will be a lot of bears that will have to cover. Okay, and we trade who's in trouble. Whenever you find someone who is in trouble, you will find liquidity. When you have massive covering, when you have panic selling, you will find great opportunity, major liquidity, the ability to get in and get out. You just have to identify these key areas. All right, so now let me grab this brush here. So this is what we were looking at yesterday. So we got that break below that 745 on that break and retest. Call that out. You want to get in early. Took it right down to the 741.7. Knew we would get to the 741.7 and bounce from that, hoping we would come on back down, but it didn't happen. What did happen is from that 741.7, we have come all the way back up. Okay, we have come all the way back up. That's what has happened. Give me 1 second. I'm sorry for the commercials. I've got to get back reset with everything. So I still got these commercials in there. Okay. All right. So what has happened is the market has bounced from that 741.7 all the way back to where she currently is now at the 745. Okay, so with that being the case, she's still within the sideways range. Okay, especially right now above this teal line. This is green for the month. On my other chart it's white, but if I made this white I want to be able to see it, so that's why I made it teal on this chart. But this represents that same area. Okay, the question for today is, will she be able to sustain above the 745, or will she come down? If she does come down, I'm not going to bite initially. I want to see her come on down here to the 743 area, okay, and hover here. Okay, give me a break and retest, and then I'll be willing to take her on the way down after that. So that is what I'm looking for and anticipating with that. Okay. So how that rolls over is I'm looking for a call 746 area, 746.7 area. So I have an alarm there. So we do have an alarm there. I'll show you on the chart. And I'm looking for a put below that 743 area. And we do have an alarm there as well. Now over to the charts. Dr. JB is in the building. Dr. JB, I will be calling you here shortly. Yes, sir. Get ready to go. Okay, got it. So that is what I'm looking at, those areas, wanting to see what happened. Here's that alarm at the 746.7. If we can get and sustain above that 746.7, okay, I will be looking at a possible call, because there is pressure all the way from the 748.5. So we do want to identify that. Some overhead resistance. 748.5. Let's go ahead. Call it this. Okay. There we go. Right there. So there is some overhead resistance at the 748.5. So I will be interested to see what takes place if we can get up, out, and above that area. Going to give the market a little time this morning. Not going to trade the first 30 minutes. Just taking my time to give the market some time. We just want to identify everything that's going on. Identify the key areas. Again, for me, the key areas are 746.7 and 743.2. Very interested in those areas and what take place there. Shout out to the team. Thank you all for joining us. Thank everybody for watching the replay yesterday. For those of you who are new, let me explain what you're looking at. You're looking at the SPY, and you're just looking at different versions of the same instrument. Top right is the daily chart. Bottom right is the weekly chart. Bottom middle is the 30-minute chart. Bottom left is the 15-minute chart. Top right, 2-minute chart. And the middle is the 5-minute chart. And there you have it. Do a top-down analysis. See who has overall control. I'll give you a quick breakdown of what I do, my rules. I don't trade before 10. I allow the charts to form. I identify who's in control of the overall market. I look at the trend for the week and the trend for the day. I identify the possible trading areas on the chart. Give me 1 second. I have a cat that wants to be on the microphone just as bad as I do. Alrighty, team. Just that fast, the market has hit the 746.7 area and is coming down from it. But it is still very volatile, still within the first 5 minutes. First 5 minutes, very volatile. The first 15 minutes have the ability to trick you. Give the market some time. Let it reveal itself to you. And then we'll be able to identify those possible trading areas as we already did. 746 and the 743. Those possible trading areas I told you are areas of greed and pain. Stop out areas and profit taking areas for both bulls and bears. Set alarms near those areas. Now wait. Identify the next support and resistance level in both directions, because that's where you're going to take profit at. Before you get in the trade, state aloud what you see. What is the setup that you are trading? For me personally, the trade that I take has to be out of my playbook. If I can't call out a trade, a setup that I see that's out of my playbook, consider gambling. I don't gamble. State aloud whether it's a scalp trade or a trend trade. Some trades you're here for a good time, but not a long time. Some trades you're here for a long time. It's going to be a rough time. If I'm scalping, I'm using an in the money 0 DTE. If I'm taking a next day trade, a next day DTE, then I'm going to use at the money, for a next day expiration. I personally use bracket orders based upon my risk and reward, and I am prepared to allow mine to go to zero. Any money that I put up, I'm prepared to lose it. So more recently, I have been trading to zero. I enter the trade, whatever it is, as per the rules for that setup that I'm doing that comes out of my playbook. Okay. Sometimes I might use a double entry method. Okay. Sometimes after that, I'll adjust my bracket order. I'll adjust it based upon the appropriate area where I need to be at. After that, I've set it. Now let it get up, walk away. If you've entered correctly, you should be in the trend phase of the pattern. As you know, there are 3 phases that the market is in at all time. We make our money in the trend phase. So that's why it's so important not to get faked out. That's why it's so important not to get faked out. For those of you who would have been too early taking a call this morning, you would have got tore out of the frame. First 5 minutes, very volatile. First 15 minutes can trick you. Continue to give the market some time. Shout out to the team. Now that the market is open, I can show you my trading view chart again now. Now that the market is open, this is my trading view chart. So again, you can clearly see that we are in this sideways action. Okay. Right, so. Okay. Right there. Let's change that to orange, as Jamani would say. Let's change that to orange. He was Miss Arbella's finest students. Peace of hands in the building. Yes, sir. So we're in this sideways trend right now. Okay. This is constriction. Constriction, expansion, and then trend. We're in constriction right now, so there's no reason to trade. After that constriction, I'm looking for expansion. Expansion is when liquidity is going to be built up in these areas. You just have to make sure you choose the right area. So if you would have got in early, then you are liquidity. Okay? So above this, I'm looking for a call. Below this, I'm looking for a put. It's just that simple. It's not easy. Oh no, it's not easy. But it is that simple. You know? And I'm so happy to be back. Best believe we will be starting that course here soon. I really think I'm looking at that 6 o'clock time slot, Eastern Standard Time, 6 o'clock. Or maybe I might do 7 o'clock Eastern Standard Time. It's going to have a replay that's going to run with it. But I'm excited about that. So for me, I'm going to let the market do what it does. Not going to jump in right now, get too excited in either direction just yet. Looking at the larger time frame, I'm clear on what I want to see before I get any money involved. And I have alarms set at those areas. Until then, we just have to be patient. And if anybody else sees something different that they would like to share with the team, I do appreciate you and would love for you to go ahead and put it in the chat. I gotta find my other phone. I had a whole phone that I had that was dedicated to the chat. Is this that phone? Where I had like people could call in. I had a number where people wanted to call and get on the air that they could. I think I found it. I'm about to call it and see if it works. I think I found this phone. Remember I was just asking you yesterday about it. Market teetering on that monthly area. This is more about the month than it is about the week, guys. Let me show you what I mean while this phone cuts on. This is the weekly chart, okay? And I want to show you something in this weekly chart. There's an algo that I have drawn in the weekly chart. That's right. You guys know how I am about these algos. We're in a control buying algo because this is the United States of America. And the market overall will always continue to go up. And when the market does fall, it just provides great opportunities for those who take advantage of it and those who have the galls and the balls to take advantage of those times when everything goes on sale. But eventually, the market will continue to rise. The proof is also right here in your face. As there were a time we were trading the market at 409, and now we're at 760. And this was just 2 years ago. Wow. Wow. Okay? So the current control buying algo, again, the most current control buying algo that began in March with March lows, March's dip, the dip that we had coming out of February into March, provided the basis for that control buying algo that you now see us hovering around now. And what led us to where we are now was the past few weeks sitting on the bottom of that controlled buying algo, breaking it, coming back up. You can see the tails on it. And then finally last week, breaking out of the algo itself. Okay? Now, The bulls understand what this could possibly mean, so they are fighting. I anticipated a sweep at the 740 area, 748 area, which is close enough. Came on down to the 741 post-market and has come back up since. So currently, this week candle is looking like a doji. Okay? Looking very doji-ish. A nice doji. But you can see where it hit that area. Even more so, the stronger level of the 741.7. It did come down to the 741. Close enough. Nothing is exact in this area, but it swept. The bulls have now come back in the market and have brought the market to where they are currently. So this morning we woke up and opened up at the 746.3. Okay? Came all the way on up to the 746.6. And there the door was shut in their faces. We are now trading again below that 745 area, but I don't trust it yet. I need to see it come below that 743. Then I can start seeing a conviction of truly being outside of the larger control buying algo, making a move towards breaking that algo. That's where I want to join. That is also what a lot of bulls are looking to see what happens before they cover. There are a lot of bulls right now who are still holding on to their position because we are still in a bullish trend. They have no reason to get out yet, that is. Now let's go over and look at the monthly chart. I'm putting a little bit of reasoning with this seasoning so you can understand what I mean. Okay? Now, you can still see this beautiful control buying algo on the monthly chart. But you also see that last month, okay, the market came all the way down. Yes, it did. All the way down. 717 before it decided to come back up. And it did it at the bottom of the algo, brought itself back up. But in the process of closing in the fashion that it did, it set itself up for a beautiful 3-candle reversal, a trade straight out of the playbook. But it's not quite yet. It's a could be not. We don't know yet. Okay? Because right now, the market is still battling for the month. Here we are on the 21st, and you have a flat, straight out doji. Okay? Flat out indecision. So if this is what the candle is looking like for the month, how dare you be talking about trading right now? Come on, somebody. What are you doing? You know what you need right now? You need a cup of... You don't need to be talking about trading. Alhamdulillah. You need to be talking about waiting. Anticipating. And all of that is still part of trading. Knowing your area. Knowing where the action's going to go down at. Knowing why. Because especially this. Let me see if you can pick up what I'm putting down. With last month. Okay? If you know, you know. What is this? What is this? What is the name of this candle right here. I already told you, for those of you who have the playbook, this is setting up to be a beautiful 3-candle reversal. And on my beautiful 3-candle reversal, it don't matter if it's a 30-minute, the 15-minute, the daily, the weekly. Here we have it potentially setting up on the monthly. It's a key area on that too. That key area is 720. If this market come below 720, good night, Irene. That will be the confirmation of the trade. My goodness. But I believe there's money to be made possibly along the way. But in this, I'm going to tell you what it is. Hangman. That's right. But in this hangman, the tail of this hangman is filled up with bulls who bought in at the 717. If the market starts trading below the 745 with 9 days left in this month and proceeds to start coming down, these guys are going to start abandoning ship because they will be in trouble. Let's identify them. Here they are. These let me tell you something. Forget the color. Yeah, it's red, but these are bulls hiding in bear skin because the bulls is what shaped this hangman, created this hangman. Now, if it doesn't work, because their anticipation was getting back above the 757 area and going up. That's what they were looking for. I'm gonna show you. Let me draw it real quick. I'm gonna show you what they was looking for. They was looking for this. They were looking for this. Okay, that's what they was looking for to happen. When they came in at this 715 last month and brought that thing all the way up to that 747, okay, they anticipated July to look like this. But that is what is happening. Okay? July right now is struggling. Doesn't look like anything but indecision. Now what I'm looking at is the potential that this could turn around and look like this. Let's bring it on down here. Hello. Now if we get this is that beautiful 3-candle reversal. And what makes this so appealing is all of these bulls who anticipated the continuation upward from the 757. Now like, damn it, I got to cover. And their covering is what will create this beautiful drop and this beautiful break, confirmation break of this control buying algo. See, they're not worried right now, but there's a lot to be worried about, and I just showed you why. Googity Bob, somebody buy me a cuppa, please. Alhamdulillah. And that's what's up. And this is from the monthly. This is from the monthly. You ain't nobody talking about no monthly. Nobody is talking about monthly. Nobody else is talking about monthly, but we're talking about it here, team. This is the anticipation of the monthly breakdown and where we could go and why it could happen and who could potentially be in trouble and where. We will revisit this tape as it is recorded. Anyway, let me zoom on in again. That's what we have for the monthly. The monthly is in a state of indecision right now. But if the market does come back down and even eats up the tail it has already created this month. This month she came down to the 739. If she gets back down there again, all the current bulls, especially right now from that 740 sweep that took place pre-market, could potentially be in trouble. Let's go ahead and look at that so you can see exactly what I'm talking about. Let me go ahead and put you back where you belong. Thank you for your assistance. Weekly charts. Okay. So we started from the monthly, then we went to the weekly. Now let's talk about what happened pre-market. Bam, bam. Pre-market, we came close to that sweep area. The bulls have come back into the market. But now, see, you don't want to take a short. And now we're breaking it down so now you can actually see the people. You can see the people. You don't want to take a short until these people are in trouble. Okay? The sweep came in at the 740, 741 area, took it all the way up to the 746.7 area. Now it has stalled out. It has stalled out and we have some sideways action. Okay? The market is currently sideways. No reason to be in anything. You don't want to get into a put until these bulls are in trouble. You don't want to get into a put until these bulls feel that they have the need to cover. Depending on where they got in. 741, 743 area, which is solid, which is why I said I would like to see the market come down to 743, hover at the 743, break and retest at the 743, which would be showing that it has no intention on going back up. Then I'm looking for that put, that early possible put. Showing that the market, as we continue to roll along, day by day, is potentially trying to close red again for the second month. After a huge month in May. May's bullish candle was ridiculous. Let's look at that one more time. So you can really understand the concept of really what I mean when I say somebody's in trouble. Okay? Let me come on there and see if I can't zoom it up one more time. All right. Wow. Not just May, but April too. But we're not going to go that far. We're not looking at it. We're not expecting the market to come down that far so soon. But look at May's candle. Lot of potential people who might need to cover. Who might be, they're not in trouble, but they're in trouble to the point that they need to take profits. And remember, those are the two areas. The people who need to stop out. Okay, what are our trading areas? Identify the possible trading areas on the chart. The trading areas are areas that people need to stop out and areas that people need to take profit. And that's what we're looking at here. It's a big, beautiful elephant bar candle. But the very next month, okay, was almost a disaster. Because there was a moment in time where this whole candle had been negated. There was a moment in time last month this whole candle of May was negated. But they didn't allow it to happen. The bulls stepped back in, bought the market all the way back up, and that is how this hangman was created. But being that this is also happening at the top of an uptrend, where we just put in a new high, this is a beautiful 3-candle reversal with a hangman in the middle. So it's gonna be a fight. Let them fight. Let us stand aside. And again, that's from the bigger chart, from the monthly. So when we come on back down here to the 5-minute, there's nothing to do. We see the sweep. You can't get in it until somebody's in trouble. Let's wait for all of these bulls to get in trouble here and feel the need to cover. Then you get your put. If not, let's see if the market gets up and above that 746.7, establish a basis, and now starts putting pressure on these bears from the 748.5. Okay? And that's what's up. My 2 alarms are set. Nothing else I can do, nothing else I can say. We're just going to let it play out. Thank you for tuning in. Thank you for joining. It's been me, Abdul Shabazz, and my cat, Shaka. You ain't got up, inshallah. We just gonna let them just keep me out and mess my thing. But when I shoot Hey! 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 Hey, that's a lick. Shut your ass up, huh? Shut up.
You write the words. What if you could hear them as a song? Go to Suno.com, switch to custom mode, and
Hey everybody, Walton Goggins here. Starting a business is never easy, but with GoDaddy Aero, that endeavor is about to become a whole lot easier.
Hey man, you got this.
Create a website that looks like you know what you're doing, even if you don't know what you're doing, because you're using a website that developed a tool that knows exactly what it's doing. It helps you design a logo. This is what we came up with. We put it here, we put it everywhere on our website, and we even put it right here. What I'm telling you, from one central command center, you can have all your social media empire operating. You're doing it all, everything, fast. Let's go, Daddy!
Imagine being able to build anything just by thinking about it. Meet Base 44, a complete AI creation platform made for anyone with an idea and a drive to bring it to life. Describe what you want and watch it take shape. You can plan, customize, and expand in any direction. From tools built for one to platforms ready for many. From passion projects to enterprise-grade systems. Everything is built in and ready to launch. It's a new world of creation, where you can go as far as your imagination takes you. Can you imagine it? Let's make your dream a reality right now.
Not detract from it.
All right, Rick, thank you for joining us with the update. It's good to have you in person on this earnings day. Rick Wurster, the CEO of Charles Schwab.
All right, still to come this hour, the CEO of Hasbro is with us, just raising guidance after reporting a Q2 earnings beat. Plus, IRS and Social Security Chief Frank Bisignano will join us after a Wall Street Journal article said he spied on colleagues while serving as JP Morgan's co-COO. His response when we come back.
Big games, big finales, big relief. Get 100 plus channels of live sports, movies, and TV in one place. YouTube TV. Try it free. Terms apply. Cancel anytime.
What if you could make a song using only your voice? Let's start with the drums. I'm gonna hit drums and click cover. Yes. This is good. Okay, perfect. I feel like the song needs a rhythm guitar. Dun, 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 dun. Changing it to guitar. I'm gonna type in rhythm guitar. Okay, I like this track. I'm gonna copy it to the main. All right, now we're adding some bass. Bum 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 bum. Okay, let's click on bass, and I'm gonna just click cover. Yes, I like this. Okay, good. All right, adding a synth for the chorus.
Time for a CNBC News update. Brandon Gomez has that for us. Brandon.
A federal appeals court has rejected former President Joe Biden's request to block the release of audio recordings from interviews he gave to a memoir ghostwriter before becoming president. Biden says the conversations were private and personal. The recordings were obtained during special counsel Robert Hur's classified documents investigation, which ended without charges. The divided D.C. Circuit panel says there is a substantial public interest in releasing the material, though its ruling is paused until August 3rd so Biden can consider another appeal. And Google DeepMind CEO Demi Hassabis is on Capitol Hill today, pressing lawmakers on AI oversight. He is pushing for a U.S.-led industry-funded watchdog to test advanced AI models before release. The pitch comes as top AI companies warn Washington that frontier systems may need tighter guardrails. And the Justice Department is investigating whether Harvard allowed Chinese donors to fund scholarships that exclude American students. Harvard says it follows the law and does not unlawfully discriminate in financial aid. The review is the latest in a series of investigations into the university by the Trump administration. Sarah, set things back to you.
Okay, thank you, Brandon. The CEO of Hasbro coming up with us after the break with a big jump following a beat and raise quarter. Plus, next hour, don't miss the CEO of Novartis on the back of their results. Several key drug patents set to expire. We'll get more on the outlook there. When Squawk on the Street comes right back. Welcome back to Squawk on the Street. Take a look at shares of Hasbro jumping after a beat on the top and bottom lines, also raising its outlook for the year, helped by the company's digital gaming revenue, which surged 27% year over year. Joining us first on CNBC is Hasbro CEO Chris Cox. Chris, welcome back. It's good to have you.
Sarah, thanks for having me.
So the story here continues to be Wizards, Magic, The Gathering. I mean, the 32% growth in this franchise. What is driving the enthusiasm here? It's been going on now for a while.
Yeah, Magic had a banger of a quarter. Actually, it's had something like 17 years of growth out of the last 19, growing like 17% per year. And, you know, Q2 is no exception, up 32%. I think it's a factor of, hey, first and foremost, it's a great game. We have some fantastic partnerships like the one that we just released with Disney, with Marvel Superheroes. The player base is growing and the number of stores is growing, both inside of the hobby channel, which is kind of where the game has traditionally been anchored, but even more importantly, inside of mass and e-commerce. It's just getting easier to find the game, and more people are trying to find it, and that's what's been powering it.
Is it also just this I mean, I was at Fanatics Fest over the weekend, and the enthusiasm there for trading cards, baseball cards, Pokemon cards, now these Magic cards. I mean, how do we know that this is not just a fad?
Well, if it's a fad, it's been going on since 1993. So I think it's a pretty long-lived one. Trading cards, collectibles in general, and this overall kind of concept that we call GEM Squared, which is an acronym that stands for Gamified Entertainment Multi-Purchase, Multi-Generational. This has been the driving the power curve inside of toys, games, and collectibles for several years, and I don't think it's fading away. If anything, I think it's strengthening.
What about, consumer products revenue increased 5%. That was, I think, better than feared. There was a cyber incident. There's tariffs. Talk about what are some of the cross currents going on in the consumer products category.
Yeah, so sure, we had a cyber incident at the beginning of the quarter, which didn't help, but we executed our way through it. We thought there would be $40 to $60 million of impact. There was about 25 in the quarter, most of which we think is going to be recoverable in Q3 and Q4. Hey, I would just say, generally speaking, the toy category is up through May. From our partners at Circana, it's up over 3%. It's been pretty broad-based. I think this older consumer, what a lot of people call kidults, is really powering it. But what we're seeing inside of our toy portfolio is broad-based strength. In the quarter, we saw Star Wars up, Marvel up, Peppa Pig up, our board game portfolio up, and that's a very broad set of consumers. So I think people are going out, buying toys, buying games, playing and collecting across a broad swath, both socio-demographically and economically.
Chris, walk us through, remind me where we are seasonally in ordering for holiday. Is it about now? Is it coming up? Are we past it? And how aggressive are you going to be loading up the shelves?
Well, I think you see orders for holidays starting to come in now. Certainly direct imports are starting to come in June. But the majority happens really in August, September, and then you start to see the reorders at the end of October and November. And I think so far so good. Certainly our retailers are seeing the demand. I think they're certainly seeing it in those GEM Squared kind of older-oriented categories. Hasbro's leaning in. And we're doing it not just in Magic the Gathering or in kind of like our Marvel and Star Wars kind of collectibles. We're doing it much more broadly. We just released last week a new Play-Doh product called Blooms, which is really for older consumers to make beautiful bouquets of flowers that they can build and collect and keep and enjoy. And I think you're going to see us doing more and more of those things. Blooms sold out basically in hours when it first started on the shelf. And I think across categories, you're going to see Hasbro lean into that. And honestly, I think the toy industry in general.
Chris, you raised guidance for the full year, although less than the amount of that you beat in the current quarter. So I guess there's some talk on the street that either it's intentionally conservative in terms of guidance, or do you see anything out there that's giving you a little caution?
Well, I'm contractually obligated by Gina, my CFO, to never say we're conservative, but let's just say we tend to go in with cautious optimism. So, we had a great first half of the year. I think we beat handily the guidance that we have, and I think we're pretty bullish on the second half of the year. Let's see how the quarters kind of play out. Generally speaking, I think we've had 9 quarters in a row of beating street estimates. I think we'd like to see that continue.
How do you characterize the consumer right now? I mean, this is definitely discretionary. I know you've had some good franchises that have kept them engaged, but are you seeing any signs of weakness, strength? How does it look?
No, if anything, I think we're seeing strengthening. The number of categories that are growing, the number of brands that are growing, the number of price points that are growing. I think it indicates that it's not just a K-shaped economy, that consumers of all kind of economic stripes are leaning in and playing. Why that is, I'm not quite sure. I think it's just kind of generally going back to toys tend to be an economically resilient category. And consumers love to collect things. We're seeing that in Magic. We're seeing that in Play-Doh with the Blooms launch. So it's broad-based.
Yeah, the little kids like the Nitos, the little squishies. I don't think those are yours, though.
Yeah.
Thank you, Chris. It's good to have you. Stock's popping 10.3%. On top of a nice rally over the last year. Thank you. Chris Cox, CEO of Hasbro.
After this, a new Wall Street Journal story today says IRS and Social Security Chief Frank Bisignano spied on fellow colleagues while serving as JPM's co-COO. He's going to join us with his response in a few moments. Later on, don't miss the CEO of Zions Bancorp. That stock down, along with some other names in the financial space. Stay with us.
Welcome back. The IRS out with news this morning saying it has recovered nearly $100 million of taxpayer money from going to deceased individuals, identifying more than 4,900 payments as part of a new verification process. Separately, the head of the IRS and Social Security, Frank Bisignano, also in the news today. In the Wall Street Journal, they're out with a front page story accusing him of spying on his colleagues while he was co-chief operating officer of JP Morgan Chase more than a decade ago. According to the Journal, Bisignano helped to, quote, keep a tight rein on employees and use the information to undermine his rivals. The Journal story reads in part, at the bank, people familiar with the matter said he spied on fellow executives, using his authority over the security department and position to access sensitive information and internal communications without an apparent business justification. Joining us now for a CNBC exclusive interview is Frank Bisignano. It's good to have you, Commissioner. Definitely want to get to the news on the fraud going to dead people. But first, wanted to give you an opportunity to respond to this front page Journal article.
Oh, Sarah, good to see you. And you know me a long time. You've watched me 12 years as a public company CEO, two-time chairman. I had the benefit to work for Jamie Dimon, Henry Kravitz, Tony Terciano, Scott Nuttall, Sandy Weil, and my track record and my public record's impeccable. Whether it was the $25 billion mortgage settlement where I stepped in to be dubbed as Jamie's guy to do it, or him naming me co-chief operating officer to work with Matt James closely on the London Whale. Obviously, there's no named sources, and JP Morgan itself denies that any of it happened. So I think I travel at the altitude. I'm blessed and honored to work for this administration and President Trump specifically. And at the altitude I travel, sometimes it's just bad journalism for political reasons.
So you deny it. I mean, the article is alleging that you directed security staff to use software to snoop in the email of rival executives like Charlie Scharf. Does that happen?
Charlie called me last night. We had a good laugh about it. And, you know, that is an unnamed source. There are no named sources in the article. My record stands for itself. Charlie and Mike Kavanaugh, all still great friends of mine. This is really bad journalism.
So it's not true?
None of it's true, ever, in my whole career.
Yeah, I mean, they also say you accessed a draft complaint from the Federal Energy Regulatory Commission about a questioned derivatives trade that was controversial. Do you recall any of this?
Never. I've never, you know, I wouldn't even know how to do that. It's not the land I've ever lived in. You guys have known me for a really long time.
Yeah.
I've never leaked a piece of information in my career. My track record's impeccable. JP Morgan denies it happened. So I can't really account for it. I feel a little bit like it's an article in relationship to Seinfeld, an article about nothing.
They also say that after years of complaints about your behavior and conduct, Jamie Dimon lost trust in you and told you that he would support you finding a job elsewhere. Did that happen? How did that go down?
Well, in 2012, in July of 2012, Jamie named me the co-chief operating officer with Matt James to go fix the London Whale problem and take over areas like compliance. The year before, he had asked me to run the mortgage company during the crisis, and we did a great job on both of those. And in his shareholder letter, he tells people he actually encourages people to not avoid conflict. And lastly, in that annual report, which was a month before I resigned, he talks about the co-chief operating officers being essential to create the right control environment. We had a great relationship, have one till today. I know he doesn't support the story either.
Oh, you do? Okay. Yeah, because you and I have talked about when you went to the government, taking all of your private sector expertise, that, you know, from JP Morgan, from Fiserv, to try to make the government more efficient. I think this article, I mean, they're raising it in light of the fact that you run Social Security and the IRS and now Trump accounts, and that's a lot of sensitive information. Should Americans be concerned?
Well, you know, I've spent my whole career protecting sensitive information. So, you know, I believe in deep cybersecurity, ability to protect the American public. I've run on a platform of PII is the most crucial thing in this job, both at Social Security and IRS. We've locked down, we've had the most effective audit we've ever had on a cyber right now at SSA after having much lower performance. And we've cleaned up the whole control environment. We've created a chief risk officer, which we never had before, and a governance structure to increase control, much like we would in the private sector. So I think we're in the best hands we've ever been in.
Yeah, I mean, fighting fraud obviously is a key initiative right now in the administration, overseen by Vice President Vance. And you have this announcement today of $100 million in fraud going to dead people from the IRS. How does that happen?
Well, you know, it was stopping it, not going to it. You know, we're stopping it. And it is the great work of the Vice President and the Treasury Secretary, and in cooperation across the whole administration. Fraud, waste, and abuse has been a platform we've been running on since we got here. And it's teamwork that you see that never happened in any administration. It's only under this president's great leadership are we able to get that type of partnership across SSA, Treasury, and all the rest of the government. And Treasury is the place where payments have been stopped to not pay them to where they shouldn't have gone.
Frank, I remember when you would come on, you were about to embark into public service. We would talk about Fiserv. You would bring us data, fresh data every month. The stock reset since you left, and there's been a lot of spilled ink about forecasts that you might have had at the time versus ones that are valid now. Stock's been unable to fill that gap. Do you think it ever does?
Well, I'm not there. I haven't been there for a long time, probably 5 publicly reported quarters. I know they went through a leadership change. That's never that good. They have a lot going on there. I root heavily for them all the time. That Clover product we built was the industry leader. We did a great job starting at First Data, KKR, and us building out a company and turning it into a really, really strong performing company. Obviously, new head coaches. I'm the second new head coach after me. I wish them the best of luck.
Frank, the $99 million in payments that were prevented going to deceased beneficiaries, that's at a $2.7 trillion, so it's 0.0036%. I mean, you've run transaction platforms. That sounds like a reassuringly low error and fraud rate if that was what we were looking at before.
Well, we're going to stay at it. That's one portion of it. It's across, we've done a lot of work in SSA to eliminate erroneous payments. Treasury and the whole government's locked down on it. So I think you can count on us continuing to drive out fraud, waste, and abuse in many avenues. And, this will be a lifelong journey here.
I mean, you're taking on additional roles at Treasury beyond, IRS now and Social Security before. You're also going to lead the expansion of the Trump accounts. And I am curious what that looks like to you and how you're going to sort of put some of this experience to use there.
Well, I think if you think about it, like I said previously on the air, probably, if you looked across and you think about what the president's allowed us to do is run this in a more structural fashion. If you thought about SSA, IRS, and the Trump accounts, right, they are very synergistic. So our ability now to have 70 million children all have Trump accounts, work closely between all these interagency items is really, really what the mission is. And, we're all maniacally focused on, obviously we have the benefits of the Dell family and what they've done, and they've set a platform. We're working closely together. That will be a platform to build off of to be able to do this for every child in America. Transformational and generational, and it's really fun to look at this startup and watch what it could do for Americans the rest of their lives.
Well, we'll continue to cover it and follow some of the efforts there. And we certainly appreciate you coming on, Frank, to address the article today. Thank you.
Well, I appreciate you guys always.
All right. Frank Bisignano, the Commissioner of Social Security and also the CEO of the IRS. A spokesperson, by the way, for JP Morgan did tell CNBC that Bisignano is distinguished for his grit and determination and that the company, quote, applauds his service to our country, both at the Social Security Administration and the IRS.
Which is not the same as saying it didn't happen. No, Frank said, JP Morgan said it didn't happen.
Said
which
that they back him, and he said it didn't happen.
Yes.
Meantime, chip stocks higher ahead of some key earnings in the space this week. Let's get to Oliver Rennick, talk about what the options market is signaling. Hey, Oliver.
Hey, Carl, traders are jumping back into semiconductor stocks this morning after an almost month-long rout in some of this year's biggest winners. 4 of the top 8 biggest trades by dollar amount in the options market this morning were in SMH. Not huge call buying, and more puts are actually trading than calls by volume. But there were some pretty big put sellers, including a $5 million put spread sold with a notably bullish outlook that was the biggest trade on the tape. The most bullish flows are in SanDisk and Nebius this morning, where call buying outpaced put buying. But interestingly, traders are actually using this bounce to hedge memory stocks via the DRAM ETF, where put buying doubled call buying this morning despite an 8% pop. Now, we've got two earnings ahead to watch this week. Texas Instruments tomorrow, where options traders expect an 8.5% move, and Intel Thursday, where implied volatility currently suggests a huge 12% plus swing, guys.
Again, I mean, I'm thinking about all of the single stock volatility we're expecting regarding earnings, Oliver. Are those extreme, or are those sort of in the middle of the curve?
Very extreme. That is the story that we've been talking about that will maybe get some resolution. I know Mike has talked a lot about that as well. It's impossible right now to have a macro discussion about the S&P 500 without a discussion that centers on volatility in name by name, as it has been such a stock-specific experience for traders. Earnings oftentimes are the catalyst that create those stock-specific experiences, but we've already been living in it. So perhaps there could be this kind of bizarro world where earnings maybe push things into one direction simultaneously. Obviously, bulls would love it if that's up, but either way, volatility is high in single stocks, especially chips going into earnings, Carl.
Yeah, Mike, the VIX has maybe stopped being a great tell as we see it sub 18
telling
today.
exactly what it's built to tell, which is the index level expected volatility over the next 30 days. And there's been all these offsetting currents beneath the index that it is suppressing the headline level. Whether those extremes have to be reconciled in a sudden and painful way is a big question. The rally in semis yesterday, it did fizzle, but today it's trying to build. It's above yesterday's high. I did note that the SOX ETF, the Philadelphia Semiconductor ETF, so that's where the 50-day average is. It's just a little bit above where we are right now. So that's sort of the first test to say, is this just a kind of a dead cat oversold bounce, or is it going to be something that we can say the group's washed out and we can sort of have it resume leadership?
And part of the fundamental, I mean, the flavor of the research notes, those that are defending the memory chips and the semis are, okay, we get these open source Chinese models that are better and more cost effective. That shouldn't diminish, actually, the demand and the appetite for the memory chips, for instance.
And maybe
there's a lot of those
it,
lines being drawn today.
Yeah, I'm thinking of the Ben Reitzes note earlier in the week where he said it's probably good for infrastructure, probably good for memory. If anything, the big AI labs like OpenAI and Anthropic are going to work harder at the application, and that puts SAS in a more vulnerable position. We did get that downgrade of Adobe today.
For sure, yeah. And also, I just think in general, look, this whole ecosystem needs a ton of new capital constantly. And are people just going to balk and say, yeah, great, we need this for the arms race, but what comes at the end of it? So those questions are going to stay with us.
Yeah. Coming up after the break, the CEO of Novartis is with us. We'll get more on the outlook with the number of key drug patents set to expire. More Squawk on the Street in just a minute. Good Tuesday morning. Welcome to Squawk on the Street. I'm Carl Quintanilla with Sarah Eisen here at Post 9 of the New York Stock Exchange. Today, investors shrugging off rising oil prices as AI fears ease and chip stocks rebound. We're joined by one top market strategist, though, who still sees an AI reset for the quarter.
Plus, watching shares of pharma giant Novartis rallying as the company reported a return to sales growth in Q2, boosted by its MS and cancer drug pipeline. The CEO, Vas Narasimhan, joins us first on CNBC to break down the quarter.
And with Alphabet earnings on deck tomorrow night, Google expanding its Gemini lineup, upping its challenge to Anthropic's Mythos. We will dive into that. Close to session highs here. S&P up almost 50 points. Dow's at 264. Maybe the bigger story today is yields. 10 years back above 4.6. The long bond basically 5.13. That's about 3 bips shy, maybe 5 bips shy of the highs that we've seen this year and several years. We'll keep a close eye on that today.
Yeah, I mean, it's light on economic data. I guess we'll get claims on Thursday. We're in this blackout period until the Fed next week, but a slow creep higher in yields, as Carl mentioned. Also this hour, President Trump will be hosting the president of Lebanon at the White House. We'll monitor that meeting, of course, bring you any highlights. I'm expected to talk, obviously, about Iran, about Hezbollah and Israel. Meantime, President is also imposing 50% tariffs on Canadian goods in response to alleged trade discrimination. Let's get to Eamon Javers for more. The two of them were in the box together a day ago for the World Cup final, and now we get more tariffs.
What a difference a day makes. President Trump is using this unusual tariff authority to impose significant new duties on Canadian imports. The president signed 3 proclamations using Section 338 of the Tariff Act of 1930 to impose additional 50% tariffs on certain goods from Canada, ranging from wine to hockey sticks to cement. These new tariffs will take effect 30 days after the signing. Now, Section 338 has been on the books for decades, but it hasn't been used to enact tariffs before. So we can expect that this will be challenged in court as part of this ongoing broader debate about the scope of the president's tariff authority. U.S. Trade Representative Jamieson Greer was on CNBC this morning. He said the administration is simply responding to Canadian action.
We've been asking for a year for the Canadians to remove these, to modify them, to adjust them. They haven't done that. And so we have a tailored action that covers a subset of Canadian goods. We aren't banning the goods like the Canadians have banned American alcohol. We're not putting a cap on them or limiting them like they've done to cars and dairy. But we have a tariff, which is, again, is a natural consequence of the Canadian retaliation.
Now, Greer also said that the U.S. expects to impose a new round of tariffs soon on as many as 60 countries based on the use of forced labor in products there. But he wouldn't say how soon that's coming, said he didn't want to get ahead of congressional notification and the like. Canadian Prime Minister Mark Carney, meanwhile, issuing a statement yesterday responding to the U.S. tariffs, saying the trade war has raised costs for families, particularly here in the United States. And he said Canada stands ready to engage intensively to resolve any issues. Doug Ford, meanwhile, the Premier of Ontario, responded on social media last night with a more confrontational statement saying, "I'll never stop fighting to protect Ontario. If these tariffs proceed, Canada should respond tariff for tariff, dollar for dollar." Guys, it seems like the trade war is back on. Back over to you.
I mean, U.S. definitely has the leverage. It's been hurting Canada's economy more than the U.S. It's something we talked about with Tiff Macklin, the central bank chief of Canada, a few weeks ago in Sintra. So how can Canada make good on this to get rid of the tariffs?
Sure. I mean, any number of American products that are exported into Canada could be subjected to tariffs. You see the different political responses, though, between Ontario and the national government. The idea is, do we fight this or do we try to soft pedal it and talk to the Trump administration and see if we can come up with some resolution? If you're Canada, it's a really tricky problem because just the scale of the American economy is so much bigger.
Yeah, Chrystia Freeland, former foreign minister, great piece in the FT, sort of explaining how they're thinking about this in Canada, Eamon, and she argues in the case of against the U.S., vis-a-vis the U.S., retaliation works. And the booze boycott, she says, has been powered mostly by consumer choice. And to your point, some of these provincially owned liquor companies in Ontario and Quebec not to buy U.S. booze in this case.
Yeah. Meanwhile, we just co-hosted a World Cup that was a huge success with Canada and Mexico. So, a peace in our lifetime is possible. We'll see whether we get there or not.
Eamon, thanks. Eamon Javers. Shifting to the broader markets this morning, stocks are up to begin today's session. Let's bring in Scott Cronert, U.S. equity strategist at Citi, who made some news earlier in the week. Scott, with your note arguing that the Mag 7 construct is kind of dead if you're trying to gauge large cap growth opportunities.
Yeah, Carl, I think that's right. If you look at the action of that cohort over the past 6 months, it's really been very idiosyncratic, and it's not really telling you the underlying story. It hasn't captured some of the action on the commodity semi side. And so whether you go from Mag 7 to Mag 8 or 9 or 10, in our view, it's becoming a little bit blurred here. The real storyline is the aggregate dependence of the S&P 500 on this ongoing AI build out and CapEx component that we think is a fundamental driver in many cases. But I think the Mag 7 for what it is probably lost its tethering here as a real indicator of how this is proceeding.
So, and it's going to be replaced by what?
Well, the way we look at it is it's what we call the growth cluster. And this is going to be a number of industry groups that build up to, we think, a better characterization of the AI playbook here. Now, good news, bad news, this is roughly 55% of the index and nearly half of the index earnings. It's also where most of the earnings growth expectation for this year is coming from. Literally 70% of the S&P 500 expected earnings growth this year is this cohort. So we think it's a much bigger pie that needs to be weighed in on how we measure and think about the AI playbook.
Do you think that the success of earnings for Mag 7 will be on earnings or on CapEx?
I think for Mag 7, it's going to be a little bit of each, Sarah. I think what we're looking for here is more confidence that the CapEx playbook from a multi-year perspective is still in good stead. And what you need to get there are going to be a lot of the hyperscalers and other players talking about ongoing positive supply versus demand trends, as well as this ROI construct that is going to be mission critical to getting to where you price some of these companies out longer than just 26 and 27 earnings.
Scott, you've had I think, net dovish view on rates. Is that thesis looking shaky?
Yeah, oil above 80 gives me a little bit of pause in this, Carl. You know, going into Q3, we're all in on this broadening playbook, and it was looking really good until the Iran flare-up. Oil prices back up into the low 80s is something that we're going to have to monitor here. I don't think it's going to change the setup, though, where as we go through the Q2 reporting period, we're going to hear a little bit more glass half full tone from most of corporates, whereas Q1 was a little bit more concerning on the ongoing risk of higher oil prices, inflation, and interest rates.
We pointed out with Jim this morning that of the top 10 Dow names for the year, 8 are either in healthcare or financials. I'm wondering if you think that's a trend that can sustain itself through the second half.
Well, I think this broadening playbook will probably end up standing on its own, but it would be nice to have, again, this ongoing perception of a downward trend in inflation getting to the point where we can price out some of this expectation for a fall Fed rate hike. I think as we get that sets up. But the underlying storyline really is as you take a step back from the AI trade for now, structurally a little bit different discussion, the money's going to have to go somewhere, and it's going to look for some combination of where there's confidence in earnings and where there's probably still sort of a contrarian bet. And I'd say banks fit the confidence in earnings, whereas healthcare fits the contrarian bet.
You also are overweight consumer discretionary, I think. Yes, and I highlighted some of the early comments we're getting from Ally and Equifax and Synchrony that, you know, on consumer credit and consumer spending has been pretty positive. Do you think that the market is too sort of bearish on the group, or is it just a tale of winners and losers there?
Yeah, I think the market's too bearish, Sarah. So if you look at, well, I guess an S&P 500 consumer discretionary is going to be influenced by a couple of the big weights, obviously Amazon and Tesla. But if you look at equal weight consumer discretion, it's down 3% year to date. So this is the market telling you it's been concerned about this nagging higher oil price, inflation, interest rate, labor condition. And in our opinion, that sets up for better price action as we go through Q3 and into the back half of the year. So color us incrementally constructive on the consumer setup into the second half.
Finally, Scott, I mean, the tape is so full of stories about hidden debt at the hyperscalers, whether or not the ongoing supply of AI debt, so to speak, can be contained, whether spreads can be contained. Yesterday, there was a story about CLO exposures. I mean, how much of that are you worried about?
I'm all of it, Carl. I think these are all issues that we're going to have to wade through. And again, I'm going to come back to the storyline here. The way we're going to handle all of this eventually is that you're going to get confidence that the underlying demand for AI compute is a real thing and a persistent thing. And that companies are going to judiciously spend, and the hyperscalers and all the investors are going to get to a point where they're pretty comfortable that they can earn this nebulous ROI, level that will essentially justify a lot of this. But this is going to be with fits and starts, which is, again, part of the reason why we downgraded tech going into Q3. Is why we're underweight communication services. But again, so this all plays into that reset playbook. And as we go into the back half of the year, look out to 27, I think we'll get a little bit more clarity on this demand versus supply and ROI picture.
Yeah, it has been pretty interesting, this current shift in the middle of the year. Scott, hurry back. Thanks for the help today. Good to see you. Scott Croner.
All right, coming up, we're going to dig into some earnings movers. CEO of Novartis will join us on the latest quarter as the company returns to sales growth, also reaffirmed their guidance for the full year.
Plus, have private wealth flows bottomed? We'll talk about what to expect as the alternative asset managers begin reporting their results. Squawk on the Streets back in a moment.
Welcome back. Are private wealth flows poised for a rebound? Leslie Picker joins us with more, digging into that story. What do you see, Leslie?
Hey, Sarah. Yeah, so gross flows into private markets wealth channel have declined 11% from last year's levels, according to Jefferies. If redemptions in some funds hadn't been gated, the outflows would have been invariably worse. That's largely thanks to months of negative headlines surrounding private credit and broader confusion about the way that these semi-liquid vehicles work. However, it can take months for this type of negative sentiment to shift, but there is a chance that flows bottomed in May. Fundraising into these products saw a 51% jump month over month in June. The question is whether that momentum continues in July and beyond, given the perception that the private wealth channel is imperative for the group's growth. The recent headwinds have borne out in how the publicly traded alts have performed. Each of them has declined. Look at those numbers, double-digit percentages year to date. And last year was broadly negative for the group as well. Blackstone is the first of the alts to report second quarter earnings in about a little less than 48 hours time, which may give investors a sense as to whether the private wealth flows have troughed. For more coverage on alternative assets, you can subscribe to our newsletter Inside Alts using the QR code right there on your screen, guys.
Do you think they come back and start talking about media coverage, noise?
Yes.
Or will they come up with a different framework to explain some of this?
I feel like if the media is the culprit continually, there's also this dynamic where, because a lot of these semi-liquid funds are gated, you see investors request more money back than they may actually want, but that takes a few quarters to really play itself out. Now, the real question is what it means for the inflows, because another thing that the executives have said is that it's largely retail investors and some big ticket retail investors who are pulling, but institutional investors have actually been putting money in. So the question is whether you're seeing net outflows or net inflows, and what component of institutional versus retail is really driving that.
But what caused the bottom? It just quieted down?
Yeah, exactly. Just the quarters of working through the people who wanted their money back and were prevented from getting it because of those gates. It takes a couple quarters for them to feel like they have enough the money that they are seeking. And as long as the headlines are okay, their credit quality is okay, there are flows into these types of products, that can kind of also help calm this. We saw this with BREIT a few years ago, which is Blackstone's real estate fund. They saw, redemption requests, they were gated, there were all sorts of, negative headlines surrounding that. It took a couple quarters and then they just kind of worked through it.
Okay, thank you, Leslie. Leslie Picker.
Let's get you to the White House, where the president is meeting with the president of Lebanon today, and listen in.
Action we took against the Houthis. And we've had no problem with the Houthis. They've had no problem with us for a long period of time, including during this conflict. I think that if there is something like that, we'll just have to take care of business.
The Speaker of the Lebanese Parliament rejected the agreement between Lebanon and Israel and said it's a sedition. It's going to cause civil war. He's the Speaker of the Lebanese Parliament, and he speaks for Hezbollah. He's Hezbollah's big brother. What do you have to say about that?
Well, maybe I'll let you speak to that.
Actually, the framework doesn't require the endorsement of the Parliament. Okay, it's part of our Constitution. It's a prerogative of the President, and we are committed to it. And I think the Speaker of the Parliament is really wants to see the end of this war. He's from the south, and he knows he did his best to rebuild the south, but unfortunately the south being destroyed in front of his eyes. So he's actually supportive of what we are doing, but we need to be careful. His position as a speaker and as a leader of the Shia community, we have to understand how critical is his position. But I can tell you that Speaker Berri is a man of state. He's supportive of what we are doing, and he's supportive of ending the state of hostility, ending the war once for all.
I think when he sees, because I've heard that, he's a good person, good man, and when he sees the progress made, I'm sure he's going to come on.
NCI TV from Lebanon. I have two questions, please. When will the Israeli army fully withdraw from Lebanon? Is there a clear timeline for that? And last question, please. Last week you met with the Iraqi Prime Minister and discussed him or described him as handsome and saying he could become one of the best leaders in the Middle East. How do you describe
Which one are we talking about?
The Iraqi Prime Minister. Yes. How do you describe President?
Well, I'd say he's handsome also, and I think he could become one of the most important leaders in the Middle East, actually, if we do this, because they've been trying to do this for decades, right? Decades and decades. So if I made that statement about somebody else, I would put him in the same category.
When the Israeli army withdraw from Lebanon, is there a clear timeline?
They're in the process of doing that. They're in the process of redeploying into other sections. And again, they get along very well. That was a great agreement they signed with Lebanon, and they're redeploying.
Mr. President, the Lebanese army needs help, and the United States said that it's very important for the Lebanese army to take over the villages that Hezbollah withdrew from. How are you going to help them, and how the CENTCOM is going to be
speaking about that today.
Ensure that they will be in the
We'll
south.
be speaking about that today with your president, and we have some very concrete plans already in store for that, with others going in and helping. But they're also becoming much more self-sufficient. And we will be speaking about that. That's one of the subjects we're going to be talking about.
Thank you, Mr. President. My question is, the Lebanese army said today that Israeli forces opened fire in proximity to the Lebanese trying to deploy in one of these pilot zones. This is day 2 of the pilot zones. Are you prepared to take any additional steps to put pressure on Israel to withdraw, which I believe President Aoun is planning to ask you?
Well, I just heard about that before this conference just happened, and we'll be looking at that, yeah.
Mr. President, there are no signs that Iran is ready to stop fighting. So what is the plan? Is the plan to just keep bombing until they give up?
There are no signs. Why, do you know something that I don't know?
Well, they continue to attack our allies and
You
kill
don't know
Americans.
what the dialogue is behind the scenes, that they want to meet desperately to try and end it because they're getting decimated. You don't get that when you listen to your fake station, but you don't know. You don't know anything.
So talks are
you know
still
something
possible,
that I
like-
don't know? Do you know something I don't know?
Well, tell us.
I will tell you, they want to desperately meet, and until they're ready to meet in a meaningful way, we have no interest in even.
Mr. President, are you planning on putting any pressure or consequences on China for what you announced about them meddling in the 2020 election?
Well, we're going to talk to them about it. It took place a long time ago. I think China is maybe a little bit different today than it was then. But look, they do things and we do things to them. I'll be honest. We do things to them too. It's not a one-way street. But we'll be talking to them. Yeah.
Mr. President, it's something that doesn't get talked about a lot, but the Border Patrol recorded 14 consecutive months, no releases at the southern border. This is something you talked a lot about on the campaign trail, that you couldn't run on the job that you did on the southern border. Do you feel similarly at this point in time with midterms, considering how well of a job you've done? What is the lesson to be learned about Border Patrol?
Well, thank you for that question. The fact is, and maybe it pertains a little bit with respect to you and borders and everything else, we had a border that was totally out of control. I probably won the election, at least partially, on the border, would you say? And the border now, we literally in 14 months, I think it came out this morning, actually, it was just announced, and in 14 months we had nobody coming through, zero people. I have to send millions came through, and we had 0 people come in illegally into our country. And that's made by people that happen to be Democrats, largely Democrats, the people that do those stats. And I'm sure they don't like saying it, but we really had virtually nobody coming in, and actually say nobody, not even virtually. So it's amazing what's happened there, and very people talk about that anymore. You know, they don't like talking about that. They don't like talking about Venezuela, where we lost no people. I'll be going to Dover for something that I feel is it's a great honor for me to do it. These are people that want it, and they feel like I do, that Iran cannot have a nuclear weapon. Very simple. It's a very simple dictum. They cannot have a nuclear weapon, and they won't have. They're not going to. They have no chance of having a nuclear weapon. And as far as Iran is concerned, I'll let Pete maybe say a couple of words, but we are doing very well. We are degrading them at levels that nobody thought was possible. They're being degraded really so seriously. They did slip something through in Jordan, and if we had other operators, you know, would not happened, unfortunately. But because we have the best equipment in the world, you know, we've stopped almost everything. But when you let other people do your job, with the United States, we let other people do the job, and sometimes it doesn't work out so well. But we're going to be going and paying our respects at Dover. Pete, would you like to say just how we're doing, generally speaking?
Well, it'll be an honor as well to join you at Dover to recognize these incredible Americans committed to the cause.
That is the president in the Oval with the president of Lebanon trying to create some space for peace in Lebanon. These pilot zones, areas where the Lebanese army would take control once the Israeli army moves out. Says that Iran continues to want to meet, he says, and then address the possibility of a blockade by the Houthis, where he said if it did happen, we'd have to, quote, take care of business.
Yeah, I think the context here is really important, which is Lebanon and Israel announced a framework agreement on June 26, and part of that would set in motion for Israeli forces to withdraw, but also for the disarmament of Hezbollah, which operates, this is the Iran-backed military terrorist group that has been firing on Israel as a direct result of the war. And so clearly, as the two presidents just outlined, what they're going to be discussing is how President Trump can help enforce that and can help both empower Lebanon and the Lebanese army to fight and disarm Hezbollah, but also get the Israelis, out of the sort of the pilot zones in the country. So that, I mean, it's interesting because, first of all, this is the first visit from a Lebanese leader, from a Lebanese president to the United States since 2009. So that's pretty historic. Also, would be historic if President Trump can help sort of enforce this framework and this agreement here, because Lebanon and Israel have never, had peace. They've been in sort of a de facto war for 80 years because of Hezbollah's presence in Lebanon. So there's a lot at stake here, obviously, and it's very much related to what's happening in Iran. And he didn't say much there, the president, but he did say they desperately want to meet.
Iran, yes.
Iran.
And then, of course, the fly in the ointment on this framework is that Hezbollah's not a party to it.
Correct,
and
they've denounced it
outright, yes.
and rejected it. So Lebanon's going to need help if it wants to fight them.
Still ahead, CEO of Novartis is with us on earnings as the company returns to growth. We'll talk about the drug pipeline, pricing, and a lot more.
Later, CEO of Zions Bancorp will join us. We'll break down their earnings report, what it signals about the health of regional banks and the consumer at large. We're back in a moment.
Hey everybody, Walton Goggins here. Starting a business is never easy, but with GoDaddy Aero, that endeavor is about to become a whole lot easier.
Hey man, you got this.
Create a website that looks like you know what you're doing, even if you don't know what you're doing.
Welcome back. Novartis shares are rising after a beat across the board earlier today. Joining us now to talk more is first on CNBC is Novartis CEO Vas Narasimhan. Great to have you back. Welcome.
Hey, Sarah. Great to see you.
So it sounds like, I mean, what drove the return to growth? It sounds like it's the two key drugs for breast cancer and MS that are doing a lot of the heavy lifting right now.
Yeah, that's right. I mean, we're coming off really the biggest patent expiry we've had in our history. And the fact that we only had to slow down for a quarter back to growth, it's being driven by Kisqali, our breast cancer medicine, Kesimpta, our multiple sclerosis medicine, and then two other cancer medicines that we have, Scemblix and Pluvicto. I think importantly now, we really see the second half being all a growth story again, and we're excited now to enter that phase.
I was going to ask, because it looks like 5 other brands in the portfolio had double-digit sales declines. I guess facing the, generic competition? What does that look like from here?
We had really a historic level of generic pressures we had in the first half. So we had brands like Entresto, Tasigna, Promacta, as well as a few other brands overseas that faced generic competition. I think it's really a story of how strong our underlying growth drivers are, what we call our replacement power, the fact that only slows us down for a quarter. We're back to growth now. And we really see the second half really now getting the underlying business now really shining through, which will carry us into 2027.
Yeah, I mean, some are wondering why you didn't raise guidance in that case, because it was a 5% beat on sales, 12% on earnings.
Yeah, I think when we looked at it and we looked at the opportunities that we have to continue to invest in R&D, we had some cost phasing as well. We thought the prudent approach for now, especially in a year where we face so many generic expiries, was to hold the guidance where it is, continue to invest in the pipeline. I mean, really the story for us goes into the second half where we have 6
Big Ben in the building. Shout out to you, Ben.
We really reshape the future of the company and allow us to raise our midterm guidance. So I think it's really important that we deliver on those pipeline readouts and invest in R&D at this moment to ensure we fully execute in the years to come.
Vas, M&A definitely heating up in healthcare and in pharma too. I wonder whether your own playbook is evolving or changing?
You know, we're going to stick with the playbook we've had, Carl, which is we do a lot of deals or a fair number of deals in the sub $2 billion range. We've already done 3 this year. We see those deals as where we can actually create, returns in an attractive way, and then selectively do larger M&A. We did Avidity last year, $12 million acquisition of a novel technology platform that gets us into neuromuscular diseases. But certainly we keep looking for opportunities wherever we can find them when it fits with the platform and fits with our therapeutic areas. But I would agree with you. This year we're seeing, I think, a back to record levels of biotech deal making. And certainly the environment is getting more competitive, that's for sure.
On Avidity, I think there's a trial due. I'm wondering what your confidence level is in that drug's ability to hit the endpoint.
Yeah, nothing more I can say about the upcoming trial readout, but what I can say is we had 2 really positive milestones in the first half. We filed one of the drugs for Duchenne's muscular dystrophy. We filed that drug now with the FDA. We have another drug for a condition called FSHD that we had very positive phase 1/2 data that we're now going to go discuss with the FDA. So I would say 2 out of the 3 programs are fully on track. The third one will get the readout in the coming months. All the signals are that it's on track for hopefully a positive readout, but we'll have to see how the data plays out.
Has there been any change in your relationship with the FDA, given some of the changes at the top and leadership there? Any change in policy or in getting approvals faster?
We haven't personally experienced as Novartis any changes, but I think with some of the shifts now, we're certainly hopeful that for some of the opportunities that we have where we could get an accelerated approval, like the drug I just mentioned for FSHD, we want to have that conversation. Because I think in cases where a drug has demonstrated at least indications of efficacy and is otherwise safe, historically the FDA, especially in high unmet need areas, has been open for accelerated approvals. Last year with the previous leadership, we saw that pull back. That was a big surprise in the industry. I think we're all hoping now that the FDA gets back to its historical approach on this. When there's a high unmet need, and you demonstrate the potential to help patients, we err on the side of making the medicine available.
What would you say right now about the pricing backdrop overall, at least in the U.S.?
It's stable right now. I think with the agreements that we signed with the Trump administration and most of the companies, major companies in our industry signed those agreements. That's led to a stable environment right now. We don't see a lot of congressional action at the moment. So we expect through the midterms for it to be a pretty stable environment. Then we'll see what happens next. You know, our big priorities remain to try to fix some of the issues with PBMs and the 340B system, and also hopefully try to fix some of the elements of the IRA that have really hurt us, like the pill penalty. But for right now, through this voting season in the fall, we don't expect much movement on any front.
So is the MFN, the Most Favored Nations pricing agreement that you mentioned, is that lowering drug prices for Americans?
I think it's early days. We're already, of course, seeing that with the Trump RX website, we're making lower priced medicines available. We also have our first reporting now of making lower prices available through Medicaid, which was part of these agreements. So that's happening now. So I think you're going to start to see that flow through the system. Probably the biggest thing we're working on is overseas to try to get countries to pay their fair share for innovation. We see a mixed picture. Countries like Japan are really making movements. But we had a really negative setback in Germany, where Germany passed a law now that has really reduced Germany's ability to reward innovation. So, you know, I think it's a mixed picture overseas. We still got a lot of work to do.
Does that mean Germany's not going to have access to key new drugs?
I think Germany will see a shift in innovation for sure in terms of investments in R&D and manufacturing. And we'll have to see now. It was the case, I think, Sarah, that we thought Japan and Germany would be priority markets to figure out how to launch medicines given their relatively attractive environment. I think Germany's taken a step back. So I think we're now trying to figure out exactly what this policy means. But it was a pretty big shift in the German pricing environment.
Yeah, I know these policy frameworks can shift in a hurry. Finally, you mentioned Trump RX. There have been some reporting, because it's been about 6 months since the website's launch. One piece did a look at the percentage of name brand drugs that are available on the site. It's only like 12%. I wonder, do you think that goes higher?
I think over time, more and more drugs will list. I think the utilization of the site will really depend on how insurers treat the fact that patients pay out of pocket on the site. And that's something we're working through with HHS. What we need is for patients to get rewarded in their deductibles with their insurance plans when they actually buy medicines on their own. And that's a mixed picture. As you know, the U.S. reimbursement and pricing environment is very complex. But ideally, we get to a place where if patients pay out of pocket, they can still count that in their insurance plan. And then I think you'll see a higher utilization over time.
And finally, just listening to you talk about, innovation and how countries are dealing with it differently. We've talked a number of times, Vas, about what's happening in China. And, every day we talk about the U.S. AI race with China. I mean, what about the fact that China is closing the gap in medical innovation and drug innovation with the United States? Where are we in that? And how, as a company, are you participating in it?
Yes, sir. I think in our sector, we'd say that the shift in innovation from China is probably the most consequential thing that's happening right now, even more than AI for the biotech sector. We see now innovation in China approaching, the levels in the U.S. Clinical trials are scaling as well in China. So I think companies are we're all agnostic from where the innovation comes from. We want to find the best innovations and globalize them. And when we find those in China, that's of course where we're looking. So I think you'll see the deal environment continue to be pretty active in China. Companies like us are finding those innovations, bringing them to a U.S. around the world, partnering with those Chinese companies to globalize those technologies. I think it's also a wake-up call for the U.S. to try to streamline the clinical trial infrastructure, streamline regulations to stay competitive. I think the answer is not to block China, but actually to get the U.S. to be more competitive.
I mean, it's something that we're going to be paying closer attention to for sure. Geopolitical implications as well. Vas, thank you so much for joining us on the quarter and the big picture. Always. Vas Narasimhan, the CEO of Novartis, with quite a statement that actually it's more of a transformation, the innovation happening in China in drugs than even AI is having in the industry right
That's
now.
incredible. Always one of the best pharma interviews. Alphabet just rolling out some new Gemini models a day ahead of earnings. Our Mackenzie Sagalos has more on that. Morning, Mac.
Hey, good morning, Carl. So Alphabet debuting 3 new models this morning, taking on Anthropic in both coding and cybersecurity as it looks to regain momentum. Now, the biggest addition to the Gemini lineup is a specialized cybersecurity model that can find, validate, and patch software flaws. Google's clearest answer yet to Anthropic's Mythos, but at a fraction of the cost of larger models. And as we've seen with Mythos, the more powerful these cyber models become, the more sensitive the question of who gets access. Google is initially limiting this one to governments and trusted partners as Alphabet's AI chief Demis Hassabis meets with lawmakers on Capitol Hill today about how to police models like this one. Now, beyond cybersecurity, Google is also trying to close the gap in coding, where Claude Code and OpenAI's Codex have largely overshadowed Gemini. Its new general-purpose Flash model improves coding performance while using up to 17% fewer tokens to complete the same task. And finally, a new slimmed-down version of their Flash model, which you can think of like the workhorse that handles repetitive tasks, that really widens Google's price advantage across the lineup and highlights its greatest edge, owning the models, chips, and cloud infrastructure, because that gives it more control over cost and capacity. Kimi K3 won attention last week for beating Fable 5 on some coding benchmarks, but then hit a compute wall, forcing it to pause new subscriptions. Google doesn't have that problem. And after taking heat last week over delays, Google is giving investors a clear roadmap on the eve of earnings. Its next Pro model is being tested with partners as we speak, while its largest ever training run is underway now for Gemini 4. Shares, though, down almost 1% right now, guys.
Yeah, they were up nicely on the reports of the AI chip yesterday, though. Mackenzie, thank you. Mackenzie Sagalos still ahead. Results from a new CNBC survey showing financial pressures creeping up the income ladder. We're going to break down the results after the break.
As our country celebrates its 250th anniversary, CNBC spotlights the leaders driving business and the nation forward.
If I had to sum up 250 years of American enterprise in one word, it would be relentless. It keeps coming, it keeps getting better, it keeps innovating. I'm Vlad Tenev, co-founder, chief executive officer of Robinhood. Robinhood launched in 2015, and we wanted to create a new type of financial company, one that allowed everyone to participate in the stock market, regardless of their age, regardless of their bank account balance. And what we found was this unlocked a whole new generation of investors, and we now have over 27 million customers just in the US. Simply put, the majority of the difference between the wealthy and folks that are less wealthy is that the wealthy invest in stocks. So by opening that up to a much greater group of people, we hope to achieve not just a more equitable society, but a society where more and more of the people are actually aligned with the growth of the economy. I'm an immigrant to this country, and I was born in Eastern Europe around the time that the Berlin Wall fell. And so I could very directly compare what it was like growing up in a communist country with price controls and hyperinflation to the American economy and the American system. I grew up in one and moved at a pretty young age to the second. And I think a lot of people that were born in this country take it for granted. The one thing America has always done is America innovates and America brings in the best talent. We'll continue to be on the leading edge and really be the standard bearer for the world, economically and culturally.
I needed some inspiration for how to wear them, so I asked ChatGPT to help me. It was so useful to brainstorm how to wear them for different occasions like work, going out, running errands, and date night.
Watch baseball all season long. Catch the action live with game day features like StatsView and more from the best seat in the house. YouTube TV. Try it free. Terms apply. Cancel anytime.
Getting some more headlines from the president after that appearance in the Oval. Let's get back to Eamon Javers. Eamon?
Carl, that's right. The president took some questions on the Canadian tariffs, those 50% tariffs that he put in place yesterday. He said that's a response to the way Canada has treated the United States over the years. He says he doesn't believe Canada can survive economically without the United States. So expressing his view that the United States is in the driver's seat in terms of this economic relationship and needs to push ahead to get what it wants. He also said these tariffs were not in response to the wildfires. He said they're still looking at that. That's separate, implying that maybe there is another wave of tariffs coming behind that. Separately on Iran, the president seemed to telegraph some more military action against Iranian nuclear sites, saying that we're following the material, as he put it, and said we're going to hit a particular area very hard soon. So saying that the Iranians, he thinks, can do nothing about it. So the president expressing some sort of animosity toward Iran and the Iranian nuclear program and suggesting that military strikes are coming soon there. So a lot to watch here, and we'll see if the White House gives us any detail or if we get an announcement of any additional military strikes this afternoon, guys. Back over to you.
Okay, thanks for the update. Eamon Javers watching the president's comments with the Lebanese president as well. A new CNBC survey showing most Americans are living paycheck to paycheck, including many in the middle class. Sharon Epperson joins us with more. Sharon, what did you find?
Well, what we found was that government data out today, of course, is showing this morning that median weekly earnings for full-time workers in the second quarter rose 4.6% from a year ago. But with consumer prices up 3.9% in the same time, inflation has eaten up most of those gains. Most Americans are living paycheck to paycheck, and that is according to a new CNBC survey of more than 2,500 adults. Overall, 63% of those surveyed described their financial situation that way in the June poll, compared to 59% in March. That financial pressure is creeping up the income ladder. Nearly 2/3 of respondents with family income between $50,000 and just under $100,000 a year say they're living paycheck to paycheck in this new survey. Even the six-figure category, up to just under $250,000 a year, 4 out of 10 of them say they are feeling that pinch. Compare that to the sharp divide between either end of the income spectrum. 81% of lower income families are living paycheck to paycheck, while just 12% of the wealthiest Americans say the same. Now, for that middle income group earning between $50,000 and just under $100,000, credit card debt, car insurance, and medical bills are the biggest financial stressors after lack of savings. More than 6 out of 10 in this group have less than $500 left over every month after expenses. For 40%, a paycheck that's just 1 week late could cause a major financial hardship. And 36% say debt has delayed or prevented them from saving for retirement. You can find out ways to stay on track with your retirement savings in my Money 101 newsletter series. Sign up there at the QR code on the screen or go to cnbc.com/money101.
I mean, it just shows like a tale of two Americas, you know, because what we're reporting from companies now is that the consumer's in great shape and has been resilient, and they're getting their paychecks, and they still have jobs. So important to, I guess, zero in on the different
and important
levels.
to see how they're paying for everything, because the fact that credit card debt is one of those major stressors, people are spending, but they're not necessarily spending out of cash flow, out of money that they have readily available. Between credit card debt, buy now, pay later, there are many ways for them to finance what they need, from groceries to gas to medical bills, everyday expenses.
Yeah, it's not that long ago we were talking about caps on APR.
Exactly.
Which never really happened.
Never happened.
Sharon,
Yeah.
thanks so much.
Sure.
Sharon Epperson. Still ahead, shares of Zion's heading lower after earnings, along with some other names in the banking space. We'll break down the quarter and talk about what it signals for the regionals with the CEO in a minute.
Astrid & Mew is powered by Shopify, both online and in person.
Shopify enabled scaling by having that single view of our customers, and we have that whether they're going into one of our stores or whether they're then buying online. We have everything in one place.
What makes a daddy? Maybe it's just being the very best at what you do. And GoDaddy is the daddy of domains. Domains that give you an AI-powered website and marketing tools to grow your business, like I did. Get the right domain and the world will know your name, because you're more than an idea. You're the daddy now. Get everything to grow your business. only from the daddy of domains.
Welcome back. Take a look at shares of Zions today. The regional bank oversees more than 400 branches across the western U.S. Lower this morning on the back of Q2 results, delivering a beat on the bottom line. Net interest income below consensus. Joining us this morning in a CNBC exclusive is Zions Bank Corporation CEO Harris Simmons. Harris, welcome back. Always great to have you.
Thank you very much. Good to be with you.
I'm curious to get your sense as to where we are right now in the environment and whether or not the stock reaction reflects some funding costs or deposits or something else.
Well, I think for us it was a very solid quarter. We kind of core earnings up about 10% over last year. We had a couple of large, unusual, kind of non-recurring kinds of gains they're really helpful in building the capital base. But you strip those out, we're up about 10% over last year in terms of earnings per share. If there's a it was a disappointment in the quarter. It was probably in deposit growth. We haven't seen the deposit growth that we'd like to be seeing. Some of that we think is a little bit seasonal, but it's a very competitive deposit market and a very competitive loan market. So, yeah.
What do you think gets that deposit engine revving, either if not in the back half of this year, then into 27?
Well, we're working really hard at building a very granular kind of deposit base. We have a big focus in our business on small businesses. We bank more than a couple 100,000 of them, and we have some great products for them, and we've kind of refurbished that product set. We're promoting that heavily, as well as consumer accounts. It'll come. It's a marathon, not a sprint. But over time we've had good deposit growth, and I expect that will restart as we get to the back half of the year.
Some of the analysts are looking at the NII and net interest margin being unchanged in the quarter after a bunch of quarters of expansion. So what happens next? Can you get back to expansion, and how does the interest rate environment change that?
Yeah, we certainly think so. We think that net interest income it's really positioned for probably kind of a mid-single digits kind of increase year out. If we have more rate increases than have shown in the yield curve today, that would be incrementally helpful to us. And so that's without any loan growth. So we think that we're going to see beautiful good net interest income growth over the course of the year.
And the other question that all the analysts are asking is why not, M&A? And I know you're used to getting this question, but when you see the competitive landscape shifting and your competitors are doing deals in a somewhat friendly regulatory environment for that, at least for now, why not jump in?
Well, I think we're not immune to the concept of doing M&A. We've done a lot of it over the course of our history. In recent years, we've been very focused on a lot of internal kind of re-engineering of our systems. We have, I think, the most modern core systems you'll find in the industry, and it puts us in a very good position to be able to kind of think again about being involved in M&A. But we're not going to do it for the sake of doing it. I mean, it's really finding the right deal, the right price, the right strategic fit. And so if we found that, the economics work, we'd certainly be interested.
Yeah, Harris, looking at your geographic map, some important parts of the country, including California and Texas. We talked to a lot of regionals in the southeastern United States, but it's just good to get a read on the western part of the country, too. Our thanks to you. Harris Simmons over at Zions today. Overall market here hanging in, even with Brent getting closer to 92. Obviously, so many headlines around the war and the energy space today.
I mean, it's helpful to have Micron back up 10%, right? The momentum names, the memory chip stocks all higher as we await some of the big earnings from the semis and the Magnificent Seven, like Google, coming later this week.
Tomorrow night's going to be big. Let's get to Leslie Picker at Post 9, in for the judge.
Thank you. you, Carl, and welcome to the Halftime Report, everybody. I'm Leslie Picker in for Scott Wapner today. The investment committee making some key trades as stocks bounce following a 3-day slide. Joining me now for the hour to break down the moves, Joe Terranova, Jason Snipes, Stephanie Link, and Josh Brown. Let's get a quick check on the market. The three major indexes near session highs right now. The Dow up about 0.7%, the S&P up about 0.8%, and the NASDAQ, the leader here, up about 1.2%, thanks in large part to the AI infrastructure trade getting a pretty significant bounce today. And I want to start with Stephanie, who's made some key trades in this space recently. Steph, you tweaked your semi exposure. What brought you into the fold here?
Yeah, sure. So I sold Marvell because I was up over 100%. Same like I did with Teradyne. I think you take profits when you can take them. And then I added Micron because the stock is down about 24% from its highs and the fundamentals remain amazingly strong. We all know that, but I think it's going to be stronger for longer. When I went through the quarter, and I've been going through the quarter report over the last couple of weeks, and you know, they've signed 16 deals last quarter, 14 of which it gives them $100 billion in RPO, and that's bookings. And I think that that means that the visibility is just so much better as a result. And so I do think the AI trade is certainly not over. I think we're in the third or fourth inning at this point in time, and we are short memory. We are short compute. And that gives this company a lot of pricing power. I don't know if we're going to see the pricing power that we saw last quarter. I mean, they had 60% average selling prices in DRAM and 80% in NAND. But I do think you're going to see ASPs be stronger and just strong in general. And I think this company has about $40 a share in earnings power through the cycle. I also added to NVIDIA. We started buying that 2 weeks ago. I just believe that it's lagged so much. It's actually underperforming the group by 53% year to date. It trades at 18 times forward estimates. That's the cheapest it's traded at since 2019. And we know that they dominate the GPU market. I understand there's competition coming, but they will always dominate the GPU market in my mind. And they have new products coming. And this is a company that's growing revenues in the 80s, gross margins in the 70s, and they're going to double their free cash flow between now and next year, end of next year. And so I like that visibility as well. And I think there's a good value there.
Yeah, I saw this interesting stat from OpCo this morning, guys, with Micron and NVIDIA are the top two contributors to year-over-year earnings growth for the S&P in Q2. If these two companies were excluded, according to OpCo, the blended earnings growth rate of the S&P for Q2 would fall to 16.8% from 24.7%. That's a 790 basis point improvement. Joe, I know you own these two as well. Are these must-owns, just given their impact to earnings growth in Q2?
Well, look, I think if you have not owned them, the right perspective to take is you now have a pullback into what is technical support.
Well, you did. Micron's up 10% today.
Right. And you're technically, you're still sitting above the 100-day moving average. I think the fundamentals are well known about memory, high bandwidth memory, and the universe of AI infrastructure. We know hyperscalers will continue to spend, and they are ultimately going to benefit. I think from a sentiment positioning standpoint, they reached an extreme. They went parabolic, and you needed to work off that overbought type of condition. And I think that's in fact what you've done. So if you do not have a position, you have what I would call a low risk, well-defined point of entry here versus these critical supportive moving averages. If they break down below it, then you can make a strong argument that maybe there was a significant inflection point that was traced out several weeks ago. But I hold them from a core perspective in the ETF. I'm not adding to them here because I do think we've worked off the significant fever. And I think overall, you've seen the momentum factor come down dramatically this month. Okay, one of the worst months for the momentum factor in the last 10 years. And it seems to me you have a little bit of a handoff, and what's saving the market is the performance of the mega cap. It's your Apple, it's your Meta, it's your Amazon. They're performing, NVIDIA. They're all performing really well in July, and I think that handoff might continue. So I'm a little bit muted in terms of how I think about positioning. If you're there, stay there. If you're not there, lowest point of reference. Don't get overly excited about a trade that probably saw its most strongest intensity several weeks ago.
Well, I guess the key question too, Josh, is whether this is a factor unwind in terms of momentum and a lot of the AI infrastructure exposure, or a fundamental unwind? This is a question that Wells Fargo was asking this morning. And if it is purely factor-based and positioning-based, do you feel like that unwind is to a point now where it's completely been flushed out?
Well, the market, it doesn't matter what I think, because the market is telling you that that they're buying the dip, and they think that most of what went on was technical and not fundamental. That's why the entire AI trade is ripping today. Not just the semis, but all the non-technology companies that have been caught up in this whole AI CapEx build-out theme. They're all up. DRAM's up 10% today. The top performing stocks in the S&P: Ciena, SanDisk, Western Digital, Micron, Intel, AMD, Corning. So it's all one trade. The trade got washed out this month. Joe made a really good point, I think, and we had this handoff underneath the surface of the market that allowed us to not give up too much ground in the S&P at the index level. And the market today is telling you they want to be long these names. Now, why today? This is the thing that nobody's brought up yet. If you're bullish on this theme, you can't not be in these stocks ahead of Google, because what the Google earnings report does for us every quarter is it serves as this sort of like come on into the revival tent for Brother Love's Traveling Salvation Show. It's the affirmation that everybody needs to hear about the state of CapEx, the forward guide for CapEx, the fact that all these projects are going ahead, maybe even more projects than we thought about 90 days ago, the last time they reported. So like if you're bullish, you need to be in ahead of Google, not sitting on the sideline, because this is arguably the cleanest AI story in the entire market from a hyperscaler perspective. I also think, it's a really healthy tape. The fact that we had these stocks 20, 30% drawdowns, you would have thought, oh no, now the whole market's going to sell off because it lost its leadership. Number one, that didn't happen. And number two, this has been a really helpful reminder for traders. Ain't no such thing as one-way trades. It doesn't exist. The best stocks in the market, the most powerful names, the best earnings stories, they're going to have down days, they're going to have down weeks, or even a down month on the way toward higher prices. We need to get that reminder. If they just go parabolic every single day the market opens, then you're in for a real crash. And fortunately, this is what keeps the market honest. This unwinds some of the leverage. This gets people to actually hit the sell button on some of these 2x ETFs. Like, this is what you need for a longer term uptrend. So I'm really pleased with the way not only these stocks are rebounding, but the way the overall market is processing what's happening and living through it.
That's a really good point with regard to Alphabet earnings and the timing.
I am very good at this.
Yeah, you got some experience there. Also in kind of the fundamental camp of why we're seeing semiconductor stocks move higher today, you've got Taiwan June export orders that were kind of skyrocketing. TSMC reportedly looking to raise prices 10% next year. That's according to Nikkei. So I guess the question is, given what we've seen in terms of positioning, given some of the fundamental stories that we're digging through today, and Josh's point about Alphabet earnings, do you think these moves hold?
I do. And I think all that's what's transpired thus far, this is a matter of positioning from my standpoint. Obviously, the SOX or the SMH, whichever index you've been on the semi side, have run, to Josh's point, I mean, they've been parabolic runs that we've seen in the first half. And it is healthy to see other sectors participating, like healthcare, financials, industrial, starting to move. And I think to Joe's point, if you're not in there, this is a potential opportunity, because to your point, Leslie, at the top of the show, 48% of earnings growth is going to come from the semiconductor index going forward. So there's clear visibility on what those profits look like. CapEx is not going to slow down. You're going to hear that from Google tomorrow. They'll reaffirm and potentially raise. I think you're going to hear that from most of the hyperscalers. So I think that is not a place to ignore. And this kind of disruption that we've seen over the last couple of weeks, I think, present an opportunity if you're not there.
How should we think about CapEx and especially against this backdrop of the Chinese model competition? How critical is OpenAI and Anthropic in light of that competition to fueling the massive CapEx build out? Do you think it still continues if there is significant open source competition from China that starts to eat away at share of Anthropic and OpenAI? Is it as much of a correlation as the broader narrative may think right now?
So I think it's an interesting story. It's kind of like a mini DeepSeek moment that we experienced a little over a year and a half ago. I don't think that slows down that all the octane and the fuel in that trade. I think the CapEx story continues to be reaffirmed and move forward. But I do think we might see some discipline in the next few quarters, right? I think this is good from a disruption perspective. Listen, it's a China-based company. We're not going to be investing heavily in that direction, but I think it is a story that maybe changes the dynamics from firms going forward and how they manage this narrative. So I don't think it changes the CapEx.
So I don't know that the memory names or semi equipment names, they want that discipline in CapEx. Mm-hmm. They want to see the CapEx continue.
Right.
I think the CapEx is really important tomorrow night for Alphabet because it makes you think about two things. If the hyperscalers continue to increase CapEx, what's the effect on free cash flow? We know the obvious answer to that. Doesn't look so good. And then what's the effect on buybacks? So does that story change for the mega caps? Now, to Josh's point, you have the first pure example of monetization tomorrow night with Alphabet, and it comes in the form of cloud. So consensus says 63% growth for cloud.
Right.
The whisper number is 70% for cloud. I think it's going to be interesting tomorrow night because of the TPUs, tensor processing units. So does that mean that Alphabet benefits from maybe not having to spend as much because they have the internal usage of these chips that maybe some of the hyperscalers aren't? So I think tomorrow night is really going to be one of the more interesting mega cap earnings reports. It's going to set the stage. It's going to set the tone for memory. It's going to set the tone for semi-equipment. But I think it's also going to set the tone for whether this rotation into the mega caps can extend itself further.
Jason, what are you expecting tomorrow?
Yeah, no, I think the cloud number is a very important number to kind of extract there because even last quarter was just a blowout 60+% revenue growth number. So that I'm definitely following. I think search and ads still are the core bar, right? I think that's going to be important. Revenue growth of around 21% we're expected to see. But I think if we can get close to that whisper number of 70%, that's going to be the story as Google Cloud continues to get market share in the space, right? AWS has been the largest player here, but they're continuing to get market share in Azure and others. So I like this story. I like the vertical integration.
The full stack,
hey,
the full AI stack.
You got it.
We've got some headlines coming out on Apple. Let's get to Mackenzie Sagalos with those. Hey, Matt.
Hey, Leslie. So Apple reportedly launching a new leasing program with Klarna. They are calling it Apple Upgrade, and it apparently launches a week from today. That's according to Bloomberg. Now, this would be one of the most significant changes yet to how Apple handles sales. I am out to Apple and Klarna on this, but the report says the Klarna-backed service will cover most iPhones, Macs, iPads, and Apple Watches, both online and in U.S. stores. Customers would essentially make monthly payments into the program. It would also let them upgrade their device early. And of course, this comes right after Apple raised prices by around 20% across several products like the Mac and iPad lineup. With iPhone hikes also expected this fall, leasing lets Apple shift the focus from a higher sticker price to a lower monthly payment. Apple had previously looked at its own in-house hardware subscription program, according to a report, but canceled that plan 2 years ago. Partnering with Klarna really gives Apple the same kind of sales tool that they had been looking to offer, but without having to single-handedly shoulder all the financial risk that comes with it. Now, I will say, shares of Klarna, they're getting a boost on this, 2.5%. Apple shares also higher. But I'm looking at shares of Affirm as well. That is Klarna's chief rival. They're trading lower. They've been Apple's go-to BNPL provider through Apple Pay. So I'm sure investors want to understand why they aren't working with Apple on this new leasing program. Leslie?
Yeah. Yeah, that would be an important partner for Klarna. Mackenzie, thank you so much. Josh, I want to get your take. Does this type of partnership attenuate some of the concerns surrounding the price hikes that Apple has been doing? Does it help the consumer picture for them on the demand side?
Yeah, look, I think what the consumer is going to be wanting a year from now is way less interaction manually with all the apps on their phone. They're just going to become, so right now what's happening is everybody is becoming accustomed to just having on-demand information, whether you're using Claude or you're using Gemini or you're using ChatGPT, just this ability, ask a question, get an instant answer. It's partly replacing search. In Google's case, it's actually augmenting the searches that would otherwise have happened in a plain vanilla way. They're now becoming more assisted searches with AI. But regardless, this is a behavioral change. And Apple knows what's going to come after this. Why do I have to ask questions? Why can't I give commands? So people who are working in coding are already fully having all of that workflow happening on a command-by-command basis when they're using either Codex or Claude Code. The normies, the regular people, they're not quite there yet, but Apple is trying to get ahead of that. And so having an agentic experience on your iPhone, telling it to pay for something, telling it to order your favorite thing from Starbucks, telling it to send money from your bank account to two friends because you're all going to a concert together, telling it to book a flight, telling it to arrange a hotel. That's the experience that Apple is trying to get ahead of here. So this is like one micro example on the payment side or on the new phone side. But like the bigger picture is agentic Siri and an iOS where all of the apps are forced to talk to AI and implement the things that the users are telling them to implement. This is coming so quickly. People don't even understand. I think we'll get a glimpse of it on September 1st. This is when John Ternus takes over officially. I know that's the date that people expect them to roll out the foldable phone. I don't think they're going to not talk about AI, obviously. Doesn't mean we'll get the product on that date. But everything happening with the Apple share price in the last couple of weeks, which we've been pounding the table on the show, has to do with that. The expectation of the consumer in 2027 is what Apple has to spend the rest of 2026 preparing for.
Yeah, it sounds like good news for us normies out there. I consider myself one of those. But I have to wonder what it means for software, Steph, as we think about this. This morning, we saw Morgan Stanley downgrading Salesforce and Adobe, asking the question, when does a willingness to disrupt itself play out? But they do think that the market has become too negative on software overall, with key overweights, Microsoft, Palo Alto Networks, CrowdStrike, Cloudflare, ServiceNow. I know, Steph, you own Palo Alto, CrowdStrike, and ServiceNow. Curious where you think we are in terms of software.
I have the most conviction in cybersecurity, and I have for the last 3 years because of AI. I have said many times I think cybersecurity is bigger than AI because of AI. It is not secure, and we're doing more and more AI coding, and that makes it more dangerous. And so these companies really, the cybersecurity companies fell in February and March with the rest of software, which I thought was silly, and I was buying. But by the way, so were the CEOs. Both CEOs of CrowdStrike and Palo Alto bought a bunch of shares, and it's because they see that their business is not disrupted at all. In fact, it's accelerating. Why I think Palo Alto has re-rated is because we couldn't really figure out the inorganic growth and the organic growth, because they've done a lot of acquisitions, $30 billion in the last 6 months. And so now they're breaking it out, and now you can see the net new next-gen security annualized recurring revenues and where they're coming from and where it can accelerate to. In terms of the other ones that I own, I mean, Snowflake, they have a whole new product cycle story, and they are growing and seeing an acceleration because of these new products and more migration to the workloads. And you need safe and secure data, and that's what they provide. And so I think they're going to continue to see product revenue growth in the 30s with operating margins gradually expanding. And then I would just simply say ServiceNow is the one that, is down and out. It's a lot of down and outers, but this one is down and out. But this is a mission critical software platform. And 50% of their net new business is consumption based and infrastructure based. And so I think it's a buy here. It's 24 times forward estimates, growing 20% compounded annually. And I think you will see AI help their business over time. It's a show me story, but I kind of like the show me stories with great leadership.
I want to ask you about areas outside of tech as well. Barclays said that the flows are moving. They're not de-risking out of tech. They're just going into different sectors, financials and healthcare. You actually bought more Morgan Stanley last week, I'm assuming on the heels of their earnings report?
Yeah, I mean, the stock was down 7% from its highs when they reported a blowout quarter. I mean, this company's doing everything right. Leslie, you know this better than I because you follow this beat. But total revenues of 27%, investment banking growth of 58%, trading up 69%. Wealth management is really a challenging business, and they grew at 14%. But most importantly, this is the second quarter in a row where their ROTCE exceeded expectations and came in close to 27%, industry high. And that is really very powerful and speaks to the strong execution that this company is delivering. And so I just kind of thought down 7%, I want to make it bigger, and because I don't think that capital markets are closed by any means. In fact, I think they're going to stay quite strong, and the momentum will be at their back.
Yeah, Goldman had a report out this morning, Joe, saying that they estimate $489 billion in AI-related debt financing across investment-grade, high-yield, and leveraged loan markets globally, well above the full-year estimate for 2025 of $322 billion. So it's only July, and it's already $489 billion. And Morgan Stanley and Goldman are perceived as some key winners here, alongside maybe JP Morgan and Bank of America and others as well. Goldman was upgraded to a hold from a reduce at HSBC today. You own Goldman.
Yeah.
How big of a beneficiary do you feel like these big investment banks and capital market sensitive firms will be in this huge financing build out?
The way I see it, I could be wrong, I believe they're in the sweet spot. And Goldman Sachs is a position I've maintained for the better part of the last 2 years. Leslie, as you know, there was a lot of excitement surrounding the financial sector, in particular for money center banks coming into the year. And then we had the disappointment of the spring. Mm-hmm. They reported really strong earnings in April, and they just didn't respond. I think a lot of people at that time kind of left and went to the sidelines. We're rebuilding positioning now, as I think we're understanding from these earnings, we're in the midst of a paradigm shift to where we've never seen the type of engagement that we are seeing in the capital markets, whether it's from retail, whether it's from equity flow absent the volatility, or whether it's from a lot of these companies who are out seeking capital in the debt market and then also through M&A and IPO. So the benefit is clearly going to be towards names like Goldman Sachs. You had Charles Schwab, which reported. You and I talked about that yesterday. Record quarter, record retail flow. Yes, the expectations were high. Excuse me. So subsequent to that, you didn't see the price performance today that maybe you wanted out of Charles Schwab. But if you're long, you're not leaving that position with $13 trillion in retail and RIA capital that's sitting there at Charles Schwab, and the understanding it's a record quarter and you have this record engagement. So I think it speaks to the benefit of the sector overall. And in the month of July, excluding energy, there it is, financials, they are your best sector in July, up 4%.
Jason, do you think that this dynamic has already been priced into these names at this point? Because there was so much dialogue on the earnings call just about the role that they're playing in this financing of the AI CapEx. Yep. Is this something the market fully appreciates, or do you think that this is some, still maybe early innings?
Yeah, no, I still think there's room to run. As I kind of followed, obviously, the Goldman Sachs release, which was a tremendous release. Investment banking revenue was up 55% year over year. To Joe's point, trading up 72% year over year. I mean, the stock moved 7% post the print. It's up 22% year to date. I think, as we walk into a new cycle with a new chair as Fed, new Fed chair in Kevin Warsh, tougher Fed, more hawkish tone. And as I see the conflict potentially wrapping up towards the end of the year and look to next year, I think the opportunity only gets larger for IPOs and trading revenue with just more participants in the market. I think that's exciting for banks like Goldman Sachs and many others, Morgan Stanley as well.
Yeah, more tilted toward it.
Yep.
Josh, you sold some Nike as well.
Yeah, you know what? I bought it before the earnings. The earnings were not terrible. The stock fell at first and then came all the way back. But then it just kind of was sitting there. And I looked at my portfolio and I just had other things that I thought were a little bit more urgent, other opportunities. So I may return to Nike. I do think they've just reported the last of the horrible quarters. And the quarters coming from here on out will probably just be bad and not horrible. The good news is the market still expects horrible given the price action. So I do think that there will be upside in Nike, and I haven't fully walked away from it. But for right now, I just had other things that I wanted to do with a higher priority.
What was the higher priority?
To be discussed later.
All right, looking forward to it. Still ahead, more of today's top movers, including the pop in SpaceX as it tries to snap a 7-day losing streak, up about 6% right now. And later, Josh Brown is back with his best stocks in this market. He's highlighting 3 under-the-radar winners that have been breaking out. Halftime is back in 2 minutes.
We're in such a saturated market now where there's a million brands doing the same things, but how can you stand out?
Shopify has helped me be more creative by allowing me the time to focus on the things that I'm passionate about. Even just like the data that we get, we're able to make.
Welcome back. Let's get to some committee stocks on the move today. Novo Nordisk suing Eli Lilly over what they call misleading GLP-1 advertising. Lilly up about 1.3%. Novo down slightly today. Joe, you own Lilly. What do you make of these allegations?
Okay, so from a legal standpoint, I'm not an attorney. I don't play one on TV, and I have no desire to be one. Maybe, potentially, Novo wins the case. From the perspective of a shareholder, if you want to step in and buy Novo on this news, legal action is not how you regain market share. That's not the strategy to get back your market share. You were there first with Wegovy. Lilly stepped in with Zepbound and completely blew you out of the water. It was like the Yankees and the Dodgers the other night, and the Dodgers blew the Yankees out. I was there, okay? The revenue year on year for Lilly in the last year is up 50%. The revenue for Novo is down 10%. So stay with your Lilly position. Don't believe that this is going to change something for Novo. They have to recapture the market share opportunity that they lost. I'm not sure how they do that, but it's not through the court.
How big of a role did advertising play in Lilly's ability to blow them out of the water? How big of a supplement was it for the Yankees?
Well, first of all, the commercial in question is recent. It's a recent commercial, and it's challenging the dosage levels. Okay, so now the dosage level, and I'm not an attorney, so the dosage level in Wegovy now is higher, so there's more effect. So they're making the comparison. They might be right in that regard, but that's not a reason to go buy the stock to believe that that's going to turn around your market share.
Yeah, fascinating story today. DR Horton lowering its revenue guidance. Jason, this is one you own?
Yeah. So, I mean, affordability is their story, and obviously that's a challenging narrative in this climate that we're currently in. You know, with 30-year mortgage rates at 6.6%, that's going to be a tough story. So lowering the guide kind of makes sense. The stock is trading flat for the year. I mean, there's, you know, as we look forward, the story's a bit murky. But I'm willing to be patient on this one and kind of turn the corner into 2027 as an opportunity here. But, you know, I think eventually this will kind of break through.
Yeah, basically a sideways stock in 2026. SpaceX, on the other hand, rallying today, up about 6.5% to snap a 7-day losing streak. Macquarie says the SpaceX story is in the right orbit. Steph, we also got the date of the first quarter of earnings since going public, and that also is indicative of when we could see the lock-off releases come a few days after that. So are you kind of surprised by this reaction?
Well, no. I mean, the stock has been in free fall since it peaked a couple of weeks ago. The way I view this story, Leslie, is I bought a small position and I'm putting it aside and I'm just going to hold on to it for a very long time, and I'm not going to get caught up in the price volatility, because I do expect the volatility to continue. There's 3 ways this company can win, and they have a leader that is the best in the world. They have in space. Last year, they actually did 170 missions and with a 99 success rate, and their costs are coming down dramatically. Starlink is the second way they can win. That's their profit generator. Gross margins are running at 48%, operating margins at 39%. They have 10 million subscribers. I think that could get to 200 by 2030. And then, of course, they're renting out compute. They signed 3 deals worth $27 billion this year. And I think that number you're going to see on an annualized basis get to $60 billion per year over time. So I think there's a lot of ways to win. You just got to be patient with the volatility, but I'm sticking with it.
Yeah, there's such a big gap between what analysts are saying and what the stock is doing. It's certainly an interesting one to watch.
Yeah.
Live Nation is another one that was downgraded at Susquehanna on a concentrated third quarter schedule, which they say leaves little room for error. Josh.
Yeah, look, I think this is the kind of thing that investors on a regular basis are just going to have to get used to. Like, you're going to get downgraded. I own this stock for so many years. When you own a stock for a long period of time, there are people looking for tactical opportunities to buy and sell. And you'll just see like changes in opinion, changes in price target. You're not forced to react to them. So I think it's interesting information. I think I added to the list of things that I'm paying attention to with the stock. And then I do absolutely nothing with it. And this is a name that just continues to barrel ahead to new highs. Summer after summer, their business improves. And I want to stay. Look at this chart. So look at how many times you had an opportunity to react to a sell side note, or not react at all. And that's the path that I've chosen here.
Yeah, consumer experiences still very much in focus. Up next, Mike Santoli joins us with his midday word.
Make your browser fast. Make your browser safe. Make your browser Chrome. Choose Google Chrome for your computer.
We're back on Halftime Report. I'm Brennan Gomez with the CNBC News Update. The Gates Foundation revealing that an external review found no evidence of payments to Jeffrey Epstein. The DOJ had released emails between Epstein and Gates Foundation staff, and the foundation says that a small number of foundation employees interacted with Epstein, who was trying to secure potential funding, but no fund was ever created. French senators approved a social media ban for children under the age of 15, and the lower house of parliament may adopt the legislation later today. If approved, children under 15 would not be allowed to sign up for social media accounts starting September 1st, and social media platforms would have another 4 months to close accounts already open. And Tropical Storm Bertha is strengthening in the Gulf of Mexico as it slowly turns towards the Florida Panhandle and Alabama. The second storm of this year's Atlantic hurricane season is expected to produce 2 to 4 inches of rain and isolated totals of 8 inches through Friday along the Gulf of Mexico. As of this morning, the storm had sustained winds of 50 miles per hour. Leslie, send things back to you.
Thank you, Brandon. Yeah, bracing for another storm up here in the Northeast as well. Senior markets commentator and overtime co-anchor Mike Santoli joins us with his midday word. You got semis bouncing. Question is whether this can actually hold or if we're going to continue to see this back and forth rotation.
Yeah, reloading yesterday's attempted rally in the group. It did kind of have a decent morning and then faded. It does seem like there's a little more behind it today. I was looking at the 10 worst performing S&P stocks on a quarter-to-date basis, so that's June 30th. They're all up like an average of 5 or 6% today, and that's basically semis plus Caterpillar plus Tesla. So that suggests a little bit of squaring up, and let's not get too negative into the meat of earnings season. I do think it's still very evident that when semis are up, something else has to be down. And so you do still have this dynamic where the other like hyperscaler stocks are kind of, weaker, and it's this back and forth. The eco-weighted S&P is not up nearly as much as the market cap weighted. I don't think it's a problem, but I think it tells you that it's the dispersion that's just sort of being forced on this market on a day-to-day basis, and it's not something that necessarily is kind of ebbing and flowing even with macro information.
When was the last time you saw something like that happen? Was it Mag 7, where you just get this binary nature of the market?
Right. So, I mean, some of it is just an outgrowth of the concentration, right? So the fact that semis are 18% of the S&P market cap means they can do one thing while the rest of the market does another, and the index as a whole, it kind of just hangs out there in the middle.
Mike, it looks as though the market's just dismissing completely the move in yields. Pushing towards highs. The last several years, when you get that push higher in yields and ultimately the market breaks, the return to concentration comes back once again. Isn't that the experience?
Yeah, no, totally. I mean, I always said the broadening trade kind of operates with the permission of the bond market, right? So you usually need to have yields in retreat. You have to have oil in check. We'll see if that's the case. I wonder sometimes if the thresholds get changed in terms of what absolute yield level is going to matter. But, 2-year back to 4.25, you're barely down at all since you had those really reassuring inflation prints from last week, and it's 50 basis points above where Fed funds is. So we're back to this mode of saying, I guess the bond market thinks that there's going to be hikes. Whether that matters for the market or not, who knows? Because if we're going to just play semi-earnings momentum or hyperscaler rebound, it almost is impervious to those things.
Yeah, good point. The cross-asset allocation element is not as in focus as we are with semis versus kind of everything else. Thank you, Mike. Up next, Josh Brown's ready with his best stocks in the market.
Hey everybody, Walton Goggins here. Starting a business is never easy, but with GoDaddy Aero, that endeavor is about to become a whole lot easier.
Hey man, you got this.
Create a website that looks like you know what you're doing, even if you don't know what you're doing, because you're using a website that developed a tool that knows exactly what it's doing. It helps you design a logo. This is what we came up with. We put it here, we put it everywhere on our website, and we even put it right here. What I'm telling you, from one central command center, you can have all your social media empire operating. You're doing it all, everything, fast. Let's go, Daddy!
I can't keep track of all my subscriptions, but my BFF Experian can and could help me easily cancel the ones I don't need. Get the Experian app now. Experian.
We're back with Josh Brown's best stocks in the market. Josh, what are you focused on today?
I don't know why, Leslie, but this is always my favorite segment of the show. We are going to talk about one of the most exciting, cutting-edge areas in all the world, insurance. I don't know if you guys know this. I feel like Joe might. 85% of the KIE, that's the insurance subsector ETF, 85% of the names in that ETF are above their 50-day moving averages. These stocks are absolutely on fire. They are, maybe a little bit longer than that. They are outpacing the rest of the XLF subsectors, the rest of the market. They look better than the banks. They look better than the credit cards. It's just this confluence of events. We didn't have a lot of weather catastrophes this summer. We see premiums going up. We see profitability improved. And don't forget, a lot of these companies are de facto investing businesses, and they are investing at higher rates and getting better returns in their stock portfolios. So they're all working. We wrote about Travelers on June 11th. It was an absolute home run for viewers of the Halftime Report. We called it a case study on how insurance companies are implementing AI and improving their bottom line results. The stock's up 22% since we did it here on the show, which is actually double the KIE. So it is a leader in the space. I want to talk about, but we did that one already. So I want to talk about Chubb right now. Chubb is very much an international business. They've been growing net premiums by 14.5%. Consumer lines are up 20.5%. Life insurance business is up 33%. And there's a lot of activity from Asia to North America. The board just raised the dividend in May to 5.2%, by 5.2%. So it's a $4.08 annual payout. It is the 33rd consecutive annual increase, which makes this a dividend aristocrat. Not a big yield, but an important signal as far as quality. Company reports tonight. The street wants to see $13 billion in revenue, which would be up 5% year over year. $6.74 in earnings, which would be up 10% year over year. Management has already given pretty good guidance for this year, so we'll see if there's an uptick. You got an RSI in this stock of about 57, right in the middle of the range, still room to run. Real quick, I want to do Aflac too. This is a Japanese powered business, which we all know. The CEO is not a duck. It's a very successful company. It's been publicly traded for a long time. This is one of the biggest winners in the S&P over the very long term. They're also returning capital to shareholders at a rapid rate. $1.3 billion in Q1 between buybacks and dividends. You got a dividend yield of about 2% here. They're going to report in early August. This is, I think, a 65 RSI right now, which getting toward overbought, but not quite overbought. You could see it's been a relentless uptrend, and the stock has been obeying its 200-day almost the entire way up. So we like these two names. They're on our list of best stocks in the market, and they're not AI. They're very much living in their own lane, and earnings are growing, and I think they should be on people's radars.
Yeah, definitely under the radar. Nice job. I learned something there. Thanks, Josh. Coming up, options action. Oliver Rennick is following the move higher in Bitcoin. Halftime is back after this.
adding forkful meals into my weekly.
Welcome back. Let's get to today's options action. Our Oliver Rennick is live at Cboe Global Markets in Chicago with more. Hey, Oliver.
Hey, Leslie, if you're looking for clues on the direction of the market, a steady climb in crypto prices and related stocks might suggest a firming of risk appetite. Bitcoin's up almost $10,000 the past 3 weeks, while stocks have been chopping sideways. And options flows in pretty much every corner of crypto look quite bullish compared to the rest of the market. In the Bitcoin ETF IBIT, call volumes double puts. And in strategy, traders are selling puts and buying calls. But in Coinbase, we see a strong bullish bias after a 13% rally today as the stock bounces off a multi-year low around $150. Of the 130,000 options traded in Coinbase today, 93,000 are calls, with traders buying 7 times as many calls as puts. The most popular contract by volume right now is the 190 strike call expiring Friday. That needs a 7.5% rally to pay off by the end of the week, Leslie.
All right, Oliver, thanks for staying all over it. Oliver Rennick. Steph, you own Coinbase, right?
Yeah, I do. It's a small position. I have no idea what's going to happen with the price of Bitcoin on a day-to-day basis. Quite frankly, I don't think anybody really does, other than it is a risk-on asset. But I actually like Coinbase because you need a buyer and a seller, not necessarily determining on the price, the underlying price of Bitcoin, but also they've also been diversifying into other businesses as well, which I applaud. But it trades with the underlying asset, and today is a good day after a bad couple of months.
Yeah, down 59%, I believe, from its 52-week high last July. Josh, you own Bitcoin, right?
Yes. Some days I'm really excited that I own it, and some days I don't even look at it. So I guess I'm like everybody else in crypto land. I don't really have any idea. If you told me it's going to 56,000 or it's going to 76,000, I wouldn't argue. I couldn't tell you.
Just
I want to point out I'm in it since 2017, so I'm almost an OG, not quite.
Wow. Well, there you go. It's up 2.3% today. Still down about 24% year to date, though. Stay with us. Final trades coming up.
Are you following the Halftime Report podcast? What are you waiting for? Look for us in your favorite podcasting app. Follow the Halftime Podcast now.
For 250 years, America has stood on grit, sacrifice, and stubborn belief. Small business owners have carried that spirit in every generation. I have lived it myself, starting in a flooded basement and learning payroll the hard way. Mike Capel here, Patriot Software's founder. We built Patriot to honor that legacy with accounting and payroll done right. As we celebrate 250 years of independence, visit patriotsoftware.com and celebrate with our Independence Day offer.
We are back with final trades. Josh, we'll start with you.
Oh, I think I just want to point out NVIDIA is finally starting to act better on down days for tech. I think that's new and we should pay attention.
Yeah, up 1% today. Steph.
United Healthcare, the CEO is doing his job in turning around the company. The turnaround is happening. They just guided to $20 a share. The stock is cheap. It should be bought.
Jason.
Goldman Sachs capital markets revenue was up 53% year over year. I like this one.
And last but not least, Joe.
If there's complacency anywhere in the market, it's surrounding the price of oil. In the last 2 weeks, oil has gone from 69 to now 85. Even energy traders are dismissing it and saying, okay, oil's going to go right back to 70 soon enough. We're not really going to get excessively long. I think you need to allocate in that direction. Yesterday I said Valero. Today I'm going to say Diamondback Energy, ticker symbol FANG.
And that one's up 1.6%. That does it for halftime. The exchange starts right now.
Leslie, thank you very much. Chips and crypto names are powering the markets higher today, along with a raft of earnings movers. I'm Kelly Evans, and welcome to The Exchange. Shares of 3M are soaring 9% and leading the Dow. The company had better than expected earnings and revenue, raised guidance, and is becoming an AI play as it deploys optical technology to customers like Microsoft. Meantime, Cisco, they are now debuting a low-cost AI model. Yes, Cisco. Could that be another OpenAI killer? We have those details in a bit. And of course, we're watching shares of SpaceX, popping about 6%, 7% now today, as Elon Musk warns short sellers that their survival probability betting against the company is very low. But let's begin with the rebound in semis today, up 5.5% now, though still down about 13% from their June highs, amid a raft of cheaper AI models and cheaper Chinese component makers. Our next guest says all of these worries are misplaced. The market is listening to these words right now. Vivek Arya is senior semi-analyst at BofA Securities. It's great to have you here, Vivek. This trade is showing it still has plenty of juice, plenty of life left in it. And why do you think that this area has been too quickly taken out to the woodshed?
Sure. Hi, Kelly. I think tech has always been deflationary, right? Whether we look at the PC era, whether we look at internet, whether we look at smartphones, whether we look at cloud computing. So technology has always been deflationary. That's because there are a number of global forces that come together to drive the most efficient infrastructure. And I think what we are seeing right now is there was a lot of focus on the frontier model developers in the US, and now you see the Chinese model developers come to the front. And I think that competition can only be a very good thing for the enabling infrastructure layer. So I think the fundamentals are very strong. The demand environment is very strong. Supply is very well stabilized. But we just came from a quarter where the semiconductor index ran up over 80%. So I think a little bit of a breather was probably to be expected.
Okay, but you say the bigger concern a lot of people have, which is here come cheaper competitors, whether they're from China or the one we'll talk about later in the show. Here come cheaper CXMT and these other component makers, which may be, lower cost producers. And we've all seen this playbook before. When the lower cost producer comes into the market, it tends to set the price and displace the other. So why shouldn't holders of Micron and Western Digital and SanDisk and all of these names be a little bit worried about that?
Sure. So let's separate the places where the competition is happening. The large language model layer, that's where you're seeing the competition between OpenAI, Anthropic, right? All the new Chinese open source models. And by the way, there are a number of open source, open weight models that are available in the US also, including one from NVIDIA. That place is certainly getting very competitive, but we think it actually democratizes the availability of that large language model and the layer. But where you have real entry barriers, where you have the larger competitive moats, is in the semiconductor layer, right? You mentioned CXMT. CXMT does not produce any high bandwidth memory or any of the advanced NAND memory that is required for the AI layer. So I think the CXMT competition that is going to come, that is also only going to help alleviate the shortages that are in the low-end consumer part of the market, right? They will go after the PC market, they will go after the phone market that are not being served right now because all the capacity is moving to AI. So
right.
we don't think that competition means much.
They might start there, but why wouldn't they work up the food chain? In other words, once you have a toehold in this area, I'm not saying this is easy, but obviously there's a pattern here. You establish a toehold in the market, and then you ultimately climb up, whether it's them or one of these other competitors going after the most lucrative area.
Sure. Look, anything can be done. It's a matter of time and cost. Building a new fab, once you have the technology, takes between 2 to 3 years and costs $10 to $15 billion. So even if they have the technology today, by the time they put it into practice and implementation is 3 years from now. Right? So anything can be done. And by the way, it's not that the existing suppliers, right, Micron, Samsung, and others, they're not just sitting still. Every year they come out with new technology, and that new technology is implemented and co-designed with computing, with networking. So these things are not happening in isolation where somebody comes out with a cool chip and then suddenly, right, competitors swoop in. No, you have a very strong of integrated co-design activity that is going on at all the times with between the memory companies, the networking companies, and the NVIDIAs, AMDs, and Broadcoms of the world, and putting that entire ecosystem together, I think it's going to be very hard for China. It doesn't mean they can't innovate in specific subsets of that market. They absolutely can. But I think to put it all together, along with all the software and developer ecosystem, I think that's a very, very long time from now.
Two more quick questions for you. Just kind of the first on this great line that you have where you say, as we've seen more open source competition, again, from whichever place, you say, open does not mean free. Do you think people are kind of conflating those two things?
Yeah, I think we have seen in the past competition come from China in other parts of technology, right? In EVs, we have seen that in other parts of the solar industry, as an example. And I think people are looking at those past examples and they're saying, well, if they were able to compete very effectively in those areas, why can't a cheaper model essentially be a tip of that iceberg and essentially forecast, cheaper competition to come from China? But I think these are apples and oranges. Competing in AI requires, as I mentioned, co-design in 10 different things, right? You don't just come out with one thing at a time. Even look at competition within the US, right? A competition between an NVIDIA and AMD and Broadcom and Marvell and others, right? There is a reason why NVIDIA is managing to keep 70-80% of the economics of the market, because it is hard for anyone else to come in and duplicate NVIDIA's success along every one of those dimensions. So for China, who is, by the way, restricted from buying the most advanced software design tools to design their chips, who is restricted from buying the most advanced semiconductor equipment. So even if they could design the chip, where are they going to manufacture it, right? And then even if they do all that, there are restrictions in terms of how their models are going to be adopted by leading enterprises. So that's why I think it's going to be a long-term, tail risk to this industry. To me, the real thing to watch out for is not competition from China. I think that's a lot of, a kind of media clickbait type of stuff. I think the real thing to watch out for is that are the US cloud players, are they still able to invest in their infrastructure, even with this rising cost of memory and compute and networking? To me, that is the most important question.
Absolutely. So
not
meaning
competition
going
coming
back
from
to
China.
whatever Google says on Wednesday, whatever everybody says in their earnings reports, as long as they're continuing, you want to see that number still go up, or at least stay. Is it good enough to stay steady, or do you want to see it still go up?
100%. I think we have to hear directly from them that the benefit of their investment in this technology is resulting in token growth, is resulting in token demand that is going to far outpace the amount of cost that they have to put in, right? That they are able to generate ROIs. Think about what happened in the last earnings call. Yes, their CapEx all went up a lot, but we also saw record success in search, in e-commerce, in social engagement. I think that's what we need to see, that the benefits of all this technology layer are accruing by way of faster growth. I think that is the only thing that matters to investing in AI and semiconductors.
Absolutely, and you're kind of getting into this area, and Jim Cramer was tweeting about this earlier today, saying, he thinks, and there's a huge debate about this, as you know, he's on the side of we must not let our companies use these Chinese models to save a few bucks. This is vital national security. Vivek, how would you say this debate ranks in terms of overall semi demand? Do we need balkanized markets to continue to drive strong growth for all of these components? Or is it okay for you if we end up, which I'd love to ask what you think. You don't have to answer that on which side we should come down on, but how are you gaming this out?
Sure. Look, my view is, Kelly, probably biased because I cover the enabling layer. And for the enabling layer, competition between customers is great, right? Nobody wants to see, just one or two customers, right, having 80 or 90% of the economics of the structure, right? So I think my view is probably biased from that perspective. Of course, from a national security and other perspectives, right? A certain business model might make sense. And by the way, we do see that restrictive environment when it comes to, selling China, whether it is semi-cap equipment, right? Whether it is advanced memory, right? And so I think there are barriers in other markets, right? Yeah. At all. So to have some barriers in these markets, right, is not going to be welcomed, but I do think would be understood by the industry. But I think the bigger picture again is that the end state right? What we are optimizing for is not the best model. What we are optimizing for is the most reliable and scalable infrastructure that lowers the cost per token and expands adoption. I think that is the end state that I think the technology industry is going for.
And so finally, we have to go, and we'll talk more about this later on, but Cisco is now launching what they say is a very low-cost, effective AI model. How do you think about news items like that? Should we, as we get used to seeing more companies in more places launching more of these competitive models, does that just mean more business for everybody, or is there, again, kind of this downward pressure?
No, I think that's exactly the point, Kelly, that, the more customers, the merrier, the more this technology gets adopted. Because, see, AI is not just going to be chatbots, right? AI is going to go from the cloud, right, towards physical AI, edge AI. And every one of those applications is going to require a different kind of model. It's going to require a different kind of computing infrastructure. Yeah. So I say the more the merrier, right? The more number of ways of adopting and accessing this technology there are. I think that's very good for the enabling layer, right, that I covered.
Vivek, really appreciate making the time. Thanks for joining us today.
Thank you, Kelly.
Vivek Arya with Bank of America Securities. Our next guest says that whole stampede out of semis lately itself might actually be a good sign for markets and the economy. Andres Garcia Amaya is the founder and CEO at Zoe Financial. Now, here's where I'm going with this. Because as you observe, the stampede in really picked up steam back when we launched the war on Iran. And so in some ways to you, is this reset? We've all debated why the reset. Is it because of fundamental change? Vivek says no. Is it because of positioning? Some people say yes. And you mentioned, look, maybe us looking past that event now as well is allowing people to step back and actually broaden out. You don't just have to be in semis and in tech, and look at the market today, to some extent confirming that.
Yeah, so I think this earnings season in particular is going to be really important. And the reason is someone's going to be wrong. If you look at volatility at the macro level, VIX at 17, there's not a lot of concerns of macro risk. But at the same time, if you look at individual names from options volatility, that spread between kind of the macro and the micro is at the highest it has been. So someone's going to be wrong. Either the macro is reading this wrong and they're going to have missed massively in earnings and therefore they're going to drag everyone down, or they actually will perform and therefore that concern of them missing will actually just bring those names that have been falling up with the rest of the market.
So even when you look, they're showing the VIX now, but when you look at the trading behavior in the semis today, snapping back 5.5%, what does that tell you?
It shows that volatility that I was mentioning, right? So the broader market's not up or down 5%, but those names are frantically trying to figure out where they should land. And the good news is we have new information coming with earnings season that either they will actually deliver or they won't. And the hyperscalers will be key. I think those comments by Vivek were spot on, which is as long as the demand is there, those names would hold up and potentially actually spring forward from where they were prior in the year.
What I find so ironic about that is that evidently we might do away with quarterly earnings. I mean, do you not watch that they're serious about this, that we might move to semi-annual or annual? There's been so many people saying, no, don't do this. The SEC is still saying, no, we might move in this direction. So what is that going to mean for volatility in areas like the chips and all the rest of it?
I welcome knowing what's going on with the semis right now. That's for sure. And I mean, transparency has always been better than less transparency, which, by the way, on the Fed might actually be moving in that direction.
Right, the Fed's going to be less transparent. We're not going to hear from the Fed. We're not going to hear from corporate America. We're going to be out here all just placing. We're going to be looking at Kalshi and Poly markets, trying to figure out what's going on out there. It's a strange moment to have gone over the past 10 years and arrived at this place, the direction that we might be going.
Yeah, all I would say is grab your popcorn. I think this earnings season is going to be one that's going to be incredibly important.
Yeah. So you are positioned how in general at this point? I mean, where do you feel like, you know, the landscape is a little bit more firm?
Yeah, I think earnings so far have delivered, and I don't think there's any strong reason to think that they won't. Now, the expectations keep coming up higher, but there's been a healthy kind of retraction in some of the names that were the hottest. I look at sectors like financials as an interesting sector because they already started to show earnings last week. gangbusters when it comes to trading, IPOs. They're financing the hyperscalers. So it's an indirect way to play in AI, but not at the valuation that the AI names have.
Want to quickly ask you about SpaceX, which had probably debuted better than was expected. The trading behavior since has lagged, although you have a chart. Its path versus the average path of historical mega IPOs is not all that dissimilar. So, and again, today a little bit of a rebound. Here's the if people are curious, we're down 11% right now as we move through the period of time since it IPO'd. The average drawdown is 30%. Just curious your point of view on this one.
Yeah, I think to a certain extent, it's not a reflection on SpaceX in itself. It's a reflection of how much interest there is on these mega IPOs, right? And everybody, my aunt's asking me, can she get into SpaceX? And the reality is there's also a lot of selling that occurs in that first year. There's been investors that have been in SpaceX for 10, 15 years that are looking for their way out. So it's not surprising to see this.
It's not a market risk for you.
It's not. I think it's a reflection of how human behavior works. And something to keep in mind, because we will have a couple big IPOs later in the fall to keep an eye on as well.
Yeah, to beware.
Beware.
Of the immediate aftermath. Andres, thanks. Appreciate it. Good
Thank
to see
you.
you. Andres Garcia Amaya of Zoe Financial. Coming up, Oracle's credit risk climbing to a near 2-decade high. Is the data center build-out undermining these companies' balance sheets? We have a deep dive into the growing AI debt boom ahead. But first, the firm behind the benchmarks, the Dow and the S&P, they're launching a new index for digital assets. We'll talk to their CEO in a CNBC exclusive. The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back. The Dow Jones Industrial Average launched in 1896, the S&P 500 in 1957. And now the owner of those indices is launching another, a new crypto index for digital assets in partnership with Pantera. This news just broke at the top of the hour, and we're pleased to be joined by Kathy Clay, the CEO of S&P Dow Jones Indices. Kathy, it's great to have you here. Welcome.
Thank you, Kelly. It's great to be with you.
Am I overplaying this? I mean, to me, you guys don't have that many indices. It's kind of a big deal if there's a crypto one now, right?
That's actually right. We think about the investing nature of digital assets, the appetite to bring some sort of trusted, investable benchmark into this space. And so we've been very intentional about working with the right partners to bring a digital asset index that we think is more corollary to something like the S&P 500. And so working with Pantera Capital has been an amazing experience for us to bring this new index to life.
Although a lot of people over the past couple of years would say the churn we've seen in digital assets has made you wonder. I mean, the average turnover in the Dow and S&P is much lower. I would get here's what's in it now. You correct me. The largest, there's 18 constituents total. The largest 5 are Ether, Binance Coin, Solana, Tron, and Hyperliquid. So what are the requirements? How much turnover do you expect? And what do these choices represent?
Yeah, so let's just admit that digital assets moves faster than equity assets, for example. But what we're trying to bring are the same sort of principles that we have in our equity indices into digital assets. So when you think about the seasoning period, the revenue generation, the listing requirement, the liquidity behind these different protocols for these tokens, these are the things that we think matter for serious investors and asset managers in the digital asset space. And so we think because there's this likeness between what we deliver in equity indices and into this new benchmark for digital assets, we think it'll make sense for the investing public.
But Bitcoin's not in here?
Bitcoin is not in there because it's really not one of those revenue generating protocols that we think belongs in this index. It meets all of the criteria, which there are many, in order for inclusion in this index. Now, this index, just like our other equity indices, will rebalance on a quarterly basis. The top token is capped at the 35%. And no other token can receive more than 20% of the balance in this market cap weighted benchmark. So we really think that people will find the synergies between equity indices and crypto benchmarks in this new index quite compelling.
And obviously, a lot of crypto fund managers will now use this as a benchmark for their performance, and people can kind of use this as a shorthand for its performance relative to, and I think it's interesting as you emphasize the revenue generating aspect of some of these things. Is all of that legal? In other words, as we wait for the Clarity Act and all of this to pass, just explain once again, how do they generate that revenue for holders? Where is that revenue coming from?
Yeah, so these are really utilitarian-driven revenues. They're not yield-bearing instruments. And so these protocols actually have revenue that are coming from the actual usage of the protocols that we're measuring. And we really work closely with Dan Moorhead of Pantera Capital. Now, Pantera Capital, as I'm sure you know, Kelly, is one of the leading investor firms into the digital asset space. And so our methodology really looks into how are these protocols generating revenue outside of yield-based investing. And that's really how we decide what the constituents are in this new benchmark.
All right, Kathy, I want to move on and just ask you about 2 more things while you're here today. The first and foremost being your decision not to fast-track SpaceX inclusion in the S&P 500. How did you come to that decision?
So that was after a very lengthy consultation, which we typically issue when we even ever contemplate a methodology change. And so after receiving a lot of public input into whether or not we would change our methodology for fast inclusion, the independent index committees at S&P DJI really made the decision to stick to the course, to stick to our methodologies, to not move on allowing these mega IPOs to enter on a fast-track basis into the S&P 500. But this is always done with independence, with a lot of integrity, and with a lot of input from the public when we issue these consultations.
And what would you say there's been, we've had conversations on this show where critics said they wanted you to fast track because they wanted your index or thought your index should represent basically, quote unquote, the market. What would you say to people who wanted it fast tracked in order that it better reflected, quote unquote, the market?
I would just say that the S&P 500 currently represents over 80% of the market capitalization in the equity space today in the United States. So we believe the S&P 500 absolutely measures what we're trying to measure, which is the most impactful companies in the country.
All right, finally, before we go, this is a little bit of a personal little pet project, Kathy. I love now that the total return okay, for the S&P 500 and the Dow, maybe we can show these numbers on the screen, is vastly higher than the price return that we all often track very closely and refer to. The Dow, for instance, is at 134,000, where we're making a big deal about 53. This is if you were to reinvest dividends all along the way. S&P 500, 16,000. Do you think we could move over time to these being the benchmarks? What do you think?
I think that these actually do serve as a benchmark to many investors who are measuring total returns. So I do think that they are a meaningful benchmark, and a lot of investors follow them. I think there's room for a lot of our benchmarks. And as the leading index provider, we are open to a lot of our indices being benchmarks for those that want to follow a certain investing strategy or a certain total return or an equal rate return. So I think it is a benchmark for those that really want to measure it in that capacity.
I think people just need to, they might be doing even better than they realize. You know, when they look at, oh, the market's up or down. Well, did a company go ex dividend? You know, you're still doing well, and also your asset managers make sure they're outperforming the total return and not just the price return. Kathy, thank you for joining us. I know it's a big day for you guys to help explain the crypto launch and also those other concerns. We appreciate it.
Thanks, Kelly.
Kathy Clay, CEO of S&P Dow Jones. And don't miss our exclusive interview with Coinbase CEO Brian Armstrong on Power Lunch next hour. We'll talk to him about that launch, Bitcoin prices, the Clarity Act, and more. Coming up, President Trump meeting with the Lebanese president in the Oval Office today. We'll tell you what he's saying about a path for peace with Iran next. Oil prices are back on the rise today as the U.S. carried out a 10th straight day of strikes on Iran. And this morning in the Oval Office, President Trump suggested there's more to come. Eamon Javers is in Washington with the latest. Eamon?
Hey there, Kelly. President Trump did threaten imminent American military action against Iranian nuclear targets in that session, saying a new round of attacks is on the way.
We follow the material. That's where the action is. And we'll be hitting that area probably pretty soon. And there's not a thing they can do about it. Normally I wouldn't say that. If I thought they could do something about it, I would never say that. But we'll be hitting that area pretty soon, and very heavily.
Now, the president also said he'll travel to Dover, Delaware for the dignified transfer ceremony for the remains of additional American soldiers killed this week in the war with Iran. The Pentagon released the identity of another American casualty today. They said Sergeant Michael Emmanuel Swinton, 30 years old, of Fayetteville, North Carolina, was killed during the controlled demolition of a downed Iranian drone. His mother told local media that he leaves behind his wife, 6-year-old son, and 4-year-old daughter. And the Associated Press reports that sirens sounded in Bahrain and Kuwait this morning to warn residents of incoming projectiles as Iran fired on American allies across the region. That underscores complaints surfaced by Bloomberg in an article today, reporting that America's Gulf allies are increasingly frustrated by the war, which is hurting their economies. But Bloomberg reports those allies are split, with some favoring de-escalation and others pushing for more decisive American military action. Kelly, back over to you.
Well, that split is noteworthy. Eamon, thank you very much for now. Thanks, she said. Eamon Javers. Let's get to Brandon Gomez now for the CNBC News Update. Hi, Brandon.
Hey there, Kelly. Mexico's health minister said there is no evidence yet to suggest lettuce sourced from Mexico caused the cyclosporiasis outbreak. Now, the FDA reported a false positive on a Mexico-linked lettuce shipment yesterday, but said the test doesn't change its prior conclusion that the outbreak is linked to iceberg lettuce from central Mexico supplied by Taylor Farms from a separate shipment. The official said Mexico is still looking into the issue. New Jersey Governor Mikey Sherrill said a serious software issue in the state's motor vehicle system resulted in fewer than 400 non-citizens being able to vote in the state's elections. Those people self-identifying as non-citizens, but the software registered them anyway. She said the vendor responsible for administering the system is being replaced. The voters represented multiple political parties and were scattered across the state. And Google parent Alphabet has more than quadrupled its office space in Miami this year, partially driven by co-founders Larry Page and Sergey Brin's recent home purchase in the area. That's according to Bloomberg, which says the new lease was signed this spring. Kelly,
I know. And everyone's talking about how expensive Miami has become now with this influx. Brendan, thanks. Brendan Gomez. Coming up, it is a debt duel. Mizuho sees a fading overhang for Oracle, but Morgan Stanley says investors are increasingly cautious about AI debt. Who's got it right and what's the stake for the broader markets? We'll discuss that right after this. Welcome back to The Exchange. AI debt continues to soar, according to Morgan Stanley's debt financing tracker, and it's notable that they even have one now. June overtook April as the busiest month this year, with $77 billion of AI-related supply. How worrisome is this? Let's ask Brent Thill. He's senior software analyst at Jefferies, and Brian Reynolds, the chief market strategist at Reynolds Strategy. It's great to have you both here. And Brent, I know you're more constructive on Oracle's prospects and all that. So, Brian, I want to start with you. I don't know if you would raise alarm bells about this. I don't know if you view this as a healthy part of the ongoing market rally, but just kind of setting the stage for us, Brian, at a macro level, how would you read this?
So we term this as a repricing, an internal repricing of technology debt. Credit spreads haven't moved in the investment grade space for over a year, except for a bump for the Iran war. But Oracle debt has surged more than halfway towards junk. And last month, SpaceX did a giant deal, and those spreads are exploding like a rocket ship, almost halfway to junk. Even though overall spreads haven't moved, there's been movement within that sector. That's a repricing of tech debt and a repricing of data center debt.
And that repricing, Brian, just to restate it for everybody, so you're saying Oracle and SpaceX, they're seeing their debt trading like much less creditworthy types of companies. Okay, so
yeah, we're making them pay a penalty for using their balance sheet.
Right. And does this, you were obviously studied the .com, or we're in the middle of the .com period as well. Do you draw historical analogies to this? Is this just a gamble and a risk these two particular firms are taking, and the investors can decide if it's worth it? Or is this something that you think kind of regulators and people writ large, the Federal Reserve needs to have eyeballs on and be worried about?
It's nowhere near the .com bust, but there is a repricing. NVIDIA is one of the highest quality companies out there, but their debt has gone from below average pricing to above average pricing. We're making NVIDIA pay a penalty for using their balance sheet to fund data centers. That's not a real big issue for them, but it's an issue for the lower quality companies that rely on this financing.
So, Brent, let me turn to you then. And as mentioned, correct me if I'm wrong, you were pretty constructive. You think Oracle shares should be worth like twice where they are right now. It's been a horrible year for them. Then does it make sense to you that investors are saying to them, maybe it's time to tap the brakes?
Yeah, I get tap the brakes. I think, Kelly, if you look at the bigger picture, there's $2 trillion of signed contract AI revenue contracts. There's about $800 billion of CapEx being spent this year. So the actual revenue generated is exceeding that of the debt on the CapEx. And so I think you gotta start there. Second is, you're early in the build up. The last thing the top 5 hyperscalers are going to say right now is, I got 5% of the ranch built. I'm not going to build the other 95%. I mean, we are at the beginning of this AI build out, and we've heard from boards, we've heard from all the data that the ROI is pouring in, from healthcare companies to aviation companies to finance. You've seen, the job growth slow because AI can help existing employees do more things. So I think you got to look at it holistically, that we're at the beginning. But yeah, this is a concern, and we've seen this concern for the whole year. The whole group is under duress. So all the hyperscalers are massively underperforming. It's the vendors that are receiving the CapEx. This is not going to stop. These companies, I mean, Amazon's going to spend $200 billion, Meta, Microsoft. You're not going to see a pullback, because they're basically, we're in the early beginnings of this build out. Right. So the market can say, yeah, we're going to take a time out, but that doesn't mean the companies are going to change. They're not going to look at their stocks and say, well, we're not going to do this AI thing because investors are bummed out about our stock price in the last month. That's not how they're thinking.
All right, let me jump in here, because I love the way that you've laid this out. We are all then relying on the fact that these companies and these leaders, this is what they're paid to do. This is usually what they're good at. They see where it's going and they think there's going to be a massive payoff. But is it possible that we get to a point several years out where the models are commoditized, and they've now, all of these companies have a lot of debt on the balance sheet, and that commoditized output product, look at Cisco's launch today, that output, they're not getting the revenue for it that they expected they would based on today's prices?
It's a risk, but we're not seeing that right now. Microsoft CFO has said that their margins are better in AI than they were in cloud at the same point.
Wow.
We're not seeing any of the data points. The CEO of Medtronic is saying we're saving lives, and AI does not get tired at the end of the day. Your doctor's eyes get tired at the end of the day, so don't get a checkup at the end of the day. You're seeing lives saved in aviation. You're seeing in finance the productivity, even in our internal team, in terms of how we're using AI in our own firm. So I think, again, we're going to go through a little timeouts and acceleration timeout. Yeah, there's a lot of debt. There's a lot of investment. This is a boom we have never seen in terms of the investment. But there are going to be 5 companies that actually build this.
Mm-hmm.
There's not going to be 20. And those companies are Amazon, Google, Microsoft, Meta, Oracle, CoreWeave. There's a handful of others, Alibaba in China. We're not talking about, 50 companies that are going to thrive out of this. There's going to be a lot of winners, but like the companies that are building the critical infrastructure are very few.
All right.
So I think we have to look at it. It is not mass market. It is a microclimate of tech that is building this. And I think so far what we can see is when I tell you $2 trillion of contracted value on a $800 billion CapEx plan, I mean, any CFO is going to sign off on that.
Brian, do you, as a quick last word, do you agree that that analysis makes sense, and that even if the market is putting a premium on this debt now, you're forcing companies to pay a little bit more, even NVIDIA, does Brent's analysis of the situation satisfy you?
Absolutely. I think we're all in agreement here. We're at the beginning of a trend of AI build-out. The credit market, though, is pricing out who are going to be the winners and who are going to be the losers. And I agree. We're not going to have 50 companies that are winners. We're going to have 5. And the credit market is winnowing those out right now. There's plenty of money available. My question is how much money and for whom? And for the firms that are the winners, like the Amazons, the Microsofts, there's plenty of money. The losers are going to be priced out of this, just like in the dot-com market. So I think we're pretty much in sync here.
All right, and you can see it, those people who are sort of on the bubble, maybe, they're trying to stay in, make it to the playoffs, to use the NASCAR analogy. Brent and Brian.
It's not a bubble yet, but it will be.
I meant like the bubble, you call it like the 16 people who want to get to the playoffs anyway. Yes, but if we're 5% there, I think we're going to have a lot more parts of this conversation to come. Thank you guys. Brian Reynolds, Brent Thill, really appreciate it. Coming up, Northrop Grumman is the worst performer in the iShares Defense ETF, ticker ITA. It's hitting a 52-week low despite saying it has a record backlog sitting at $105 billion. Could the political backdrop be weighing on investor sentiment? We'll dive into that. But first, the cyber stocks are under pressure today after Cisco debuted 2 open-weight AI models designed to help find software vulnerabilities. Palo Alto, CrowdStrike, SentinelOne, and Tenable all moving lower. We'll have those details next. Welcome back. Forget spending when it comes to AI. We were just talking about that. Saving is now in focus as cheaper Chinese models catch up. But one domestic old tech U.S. company says its new offerings are 172 times less expensive than competitors. Yes, Cisco releasing 2 small open weight models today. Christina Partsinevelos sat down with their president and has more. Please, in today's tech check, I should say, but Christina, please break this all down for us. How does this work?
It gets complicated. Well, so let's start with saying Cisco is essentially giving away AI security models for free. They're giving away the models themselves. The company is releasing a family called Antares. 2 of them open weight, meaning anyone can download them for free and then run them on their own hardware. So that's where the cost comes. They hunt essentially for known security flaws inside a company's code. Giving them away kind of takes a side in the fight right now, splitting the industry, whether AI models should be freely available to download for free or tightly controlled, like maybe what the US government is considering. President Jeetu Patel says buyers care about 3 specific things: intelligence, cost, and control. Whether sensitive code ever leaves the building. On cost, size is everything. Models are measured in parameters, the dials they learn in training. More parameters usually means smarter, but always means pricier. Cisco's models are roughly 350 million and 1 billion parameters. The biggest frontier models that we often talk about, they run into the trillion, so vastly smaller for Cisco. Cisco says one run, to your point, Kelly, takes 15 minutes on one GPU and costs under $1, cheaper than leading frontier models. However, we have to say that this is Cisco's own benchmark that they're using, so you have to take that with a grain of salt. Listen to what Jeetu Patel had to say.
Think about, using a frontier class model for every single attack is like saying, I'm going to take a private jet to go out to a corner store. I mean, you can do it, but it's not really necessarily a thing that you might want to do all the time.
And speaking of others, Google also released its own cybersecurity model today, built to find vulnerabilities and patch them, but only for governments and trusted partners at first. And I want to point out, free does not mean cheap right away. You've been talking about that with your previous guest earlier in the show. AI companies bill by the token, roughly a piece of every word, every time a model answers. Patel expects those prices to fall, which is great, and says that's not necessarily bearish.
Token costs will need to keep going down. But that doesn't mean that the total spending goes down. The spending will go up as the token costs go down.
Why Cisco charges nothing for the models, essentially, is what he's saying. But Patel says the money is in the software around them. Of course, all the extra products that they can add, deciding which jobs go to a cheap model and which are paying up for. So the future is a lot of models.
Well, we're seeing the cybersecurity stocks sell off today, which I'm trying to understand why that would be the knee-jerk reaction. I mean, I can see how this would disintermediate potentially an Anthropic with its expensive, model that, but maybe these names too are also trying to. Everyone's in that space.
Or maybe this is a curveball. It could just be the general software mix as a whole is often used as a source of funding for chips, and the fact that chips, the SMH is over 3% higher, the IGV, which is the
SMH
ETF,
is like 5.5%.
Yeah, not really
no
any
news.
And so this is less to do with catalysts. You can outline all of these headlines, but really it could just be a sentiment change. People realizing that the Chinese model is not going to be as detrimental to infrastructure, and actually you do need to keep spending on GPUs and especially memory in the near term. And then, so that's why they're buying it. And plus, the stocks have dropped so dramatically. It was just an opportunity to get in. And you have all of these sell-side analysts saying, now's the time to buy on certain names, like Micron,
exactly.
Bank of America. So perhaps that's adding to the discrepancy between software, which I'm lumping cyber in, and chips.
That makes sense. Christina, appreciate it. Thanks for bringing that news to us today. Christina Partsinevelos. Coming up, $67 billion. That's how much the White House says it needs immediately to cover the costs of the Iran war. Secretary Hegseth and the chairman of the Joint Chiefs are set to testify to the Senate Appropriations Committee about that at 2:30 p.m. Eastern. But with lawmakers gridlocked and the House leaving for recess tomorrow, will the DOD get it? We'll discuss that when The Exchange comes right back. Welcome back to The Exchange. Northrop Grumman shares are down 2% despite strong results and a record backlog of $105 billion. Their sales grew in every division of the company: aeronautics, defense, mission, and space. But their shares are still down nearly 30% since the start of the Iran war. And there are concerns over the U.S. defense budget. Let's bring in Roman Schweitzer, aerospace and defense policy analyst at TD Cowen. Roman, it's good to see you. We talked to Libby Cantrell about this yesterday, and again, we understand the clock is ticking. The war has been expensive, and what does that mean for Northrop and the likes?
Hi, Kelly. It's great to be with you. Well, the funding picture for defense is really unsettled right now. Certainly, you've got the cost of the war, and not to mention other operations that the Defense Department has done or conducted over the course of the year. Obviously, Venezuela, counter-drug operations, border security, and things like that. And those are not planned missions, so they're not accounted for by Congress when it annually appropriates money. So that's certainly one aspect of it that lawmakers are trying to deal with immediately before they sort of adjourn for August and then get back in September in the mad dash to get a continuing resolution in place. But then there's also uncertainty about the broader level of what will spending be for next fiscal year, fiscal 27. And I think that's what sort of weighed more broadly on the whole group is what is that next year's spending picture, and then even, to be quite frank, after the midterm elections on November 3rd. So a lot of factors all kind of converging at the same time.
The Washington Post today says the Pentagon, after sinking billions into the Iran war, is quickly running short on cash. We know they're going to the Senate Appropriations Committee this afternoon about their supplemental $67 billion war request. We just showed the $1.5 trillion requested budget, but even the $1 trillion budget for this fiscal year, you say that money's really allocated to other things. So, and that the House and the Senate have kind of two different versions of what this is going to look like. So where's the money coming from?
Great question. I'm glad I don't have to solve the final answer. Train wreck, gridlock, cliff, whatever kind of metaphor you want to use in Washington these days, it has been a little bit of a mix-up in terms of how they're going to get that. The House would like to use a third reconciliation bill to provide some of those funds, and the House may, in fact, vote on that later this week and kick it over to the Senate, before they go home. The Senate may, in fact, try to pass something like a bipartisan continuing resolution that has a supplemental attached to it as well. That was what the late Senator Lindsey Graham, Senate Budget Committee chairman, that was sort of his preferred approach. So the House and Senate Republican leadership both have differing strategies right now. They're not on the same page. And then, of course, Democrats are not on the same page as well as sort of supporting or funding anything for, what they believe is an unwise war against Iran. So really, there's a lot of details that need to be sorted out here pretty quick because by all accounts, I've heard from folks that say, sort of Pentagon's balance sheet or finances are pretty dire because, again, these are unplanned contingencies. So, you have to pay troops and do all those other things. So these bills are adding up.
Why is Northrop in particular under pressure here? We've showed the defense ETF broadly is down. I mean, it is in the red since the war started. I'm sure there are some out there who would have thought the opposite, that maybe it'd be up because we're talking about, more spend. But Northrop really stands out as a laggard. Why?
Well, I can't really comment on Northrop specifically. I would say the group in general, going into the year when the president talked about a $1.5 trillion request. And there were certainly very strong expectations about that. But it's really kind of curious. It's almost like we're at a peak period of geopolitical risk as well as peak budget. And so I think there's two things. One, I alluded to what next year's budget will be for fiscal 27. But then also after the midterms, if the House if Democrats are able to take control of the House, then that would kind of lower multi-year growth expectations for the entire industry. So instead of robust $1 trillion plus budgets, you're looking at something much more moderated. And then the last thing I would say is for companies like Northrop Grumman or your traditional defense primes, we've seen sort of new upstarts, neoprimes, military tech fusion companies is what we call them. The Andurils and Saronics and other companies, really begin to take hold and deliver products to the Defense Department, and you see a broader industrial base as a result.
That's a great point. We've spoken with a number of those companies on the show, and it's Lockheed too. Like you said, the major ones are under pressure and maybe facing that upstart competition. Roman, thanks. We'll see what happens this afternoon and in the next few days. Roman Schweitzer, TD Cowen. That's it for us. Thanks for watching The Exchange. I'll join Brian Sullivan. He's made it back from Power Lunch after this break.
Big tech soaring as the NASDAQ 100 nearly pops 2%. Welcome to Power Lunch, everybody. With Kelly, I am Brian. Stocks near session highs. Dow 400 points. Once again, though, the action in the semiconductors, some big names spiking double digits as the market, Kelly, looks right past Iran and oil.
And speaking of big movers, we have 2 exclusive interviews coming up. Coinbase, one of the best stocks in the S&P 500 today. The largest U.S.-based crypto exchange reports progress on the pathway for new legislation. CEO Brian Armstrong is here. And a crypto miner turned AI data center company, Hut 8, signed a $10 billion lease, providing compute to big tech. With shares already up 400% in the past year, is there more to run? We'll ask CEO Asher Ganoot.
I feel like we've been doing a lot of that lately.
You have.
We have these Bitcoin miners. And did you ever come up with a name for the group,
yes,
Kelly?
AI landlords.
AI landlords. I like AI landlords. There we go. We got all that ails you. AI landlord. We've also got an action-packed hour for you. We're going to get to more on oil and crypto in a few minutes. But let us start with the semiconductors and a powerful pop in many of the big name stocks. Christina Partsinevelos with us now. And KP, give us some of the big moves and what is behind them.
Can I say not much? Well, no. Semis are bouncing again today, and there is no single headline driving this major move. After a roughly 20% drop in the stocks from late June, specifically June 22nd, the selling pressure just seems to be easing today. You can see it with really what is leading. The weakest, most oversold names are up the most. SanDisk, Micron, Marvell, Western Digital, storage name Seagate, even Lumentum, which ran yesterday on a Barclays upgrade, up over 4%. There are, of course, individual catalysts if you want them. To Brian's point, TSMC, Taiwan Semi, moving on a Nikkei report that it will raise prices on both advanced and mature nodes by up to roughly 10% starting in 2027. TSMC says its pricing is strategic, not opportunistic. Nebius jumped after NVIDIA filing showed a 9.3 passive stake. Worth being very, very careful here. This is not necessarily a new investment. Most of it is a warrant NVIDIA picked up back in March, and NVIDIA can't exercise it until September 11th. SEC rules just required it to be counted, which is why we're seeing it today, yet the shares of Nebius are still up. AMD higher ahead of its Advancing AI event, which starts tomorrow and Thursday. AMD's CEO keynote will be on Thursday. Jefferies and SemiAnalysis both point to Anthropic as a possible new customer announcement, so maybe buyers are getting in early. Micron caught a bid after Bank of America added it to its U.S. #1 list. Now, the caution. After a few strong days for semiconductors against the Mag 7, it's not gospel. TSMC, Samsung, ASML all sold off on strong results these past 2 weeks. Month to date, the Mag 7 still ahead. And software is lower today after a round of Morgan Stanley downgrades. Some of this move, though, is definitely rotational, from software into chips, not necessarily conviction. And for perspective on how normal this is, just over the past decade, the SOX, this is the index, has had 6 drops of 20% or more from their 52-week highs. The S&P 500 has had roughly 2. Volatility is essentially the price of admission in this group right now.
Yeah, that's a great point. It is the price of admission. Christina, thanks. Let's continue the discussion with our markets panel now as one of our next guests took advantage of last week's sell-off to reposition his portfolios, trimming some semis, buying into memory. One of those buys is SanDisk, up 10% today. Joining us now is Tom Hulick, the CEO of Strategy Asset Managers. Here on set with us as well is Oh-Sung Kwang, the chief equity strategist at Wells Fargo. So, Tom, is this your SanDisk move we're talking about?
Well, I think so. I mean, you've got to remain bullish on 3 reasons. I mean, earnings continue to surprise on the upside. AI spending continues to be extraordinarily strong, and the demand is real. It's not speculative out there.
And that tells you then when you see, you wake up and you see the semi trade up 5.5% today, like our last guest was saying, yeah, it's almost the market's trying to figure out what is going to happen in earnings season. And one day they're panicked and the next day they're relieved. Does that land with you?
It does. Kelly, many of the investors that we talk to kind of assume that the chip stocks are really expensive. When we just rebalanced our market-oriented portfolio as an active manager, the majority of the stocks were overweight in the semiconductor positions. But the reality is really different. I mean, these PEs are actually forward-looking quite attractive right now. Currently, they're not. But if you look at things like NVIDIA, 13 to 21 times earnings, SanDisk 24 times earnings, AMD a little bit higher, but the valuations look a lot more reasonable right now with forward earnings. So price isn't the story, it's the valuation relative to the earnings growth right now.
Oh-Sung, and you know that I like these sort of big historical data points. I just find them interesting launching points, and you note one here. July is tracking to be one of the biggest momentum reversal months in history. What does that mean? What are we reversing into and out of?
Yeah, so if you look at stocks correlation between the first half performance versus July month-to-date performance, it was negative 55%. So,
okay, so first half of the year, Jan 1, June 30th, versus July, completely inverted.
Yeah, exactly. So whoever outperformed in the first half of the year underperformed so far in July. And whoever underperformed in the first half of the year is outperforming in July. So this is basically a momentum reversal.
Like
so
what happened? It was just a calendar turn, or maybe it was the calendar turn.
Yeah, maybe there's a little bit of that, but I also think there was a positioning extreme in one side of the market, which is basically AI and the momentum trade. And I see this as essentially a factor unwind that we are seeing, momentum factor unwind because of positioning. And there was a little bit of overhang given the Chinese open source model. And now that it happened, and we know what the bottom line is, that it's actually positive for compute. So I think positioning has reset. I think there is a bull case heading into the earnings season, and I think hyperscaler capex, the trend is going higher. So I think this earnings season will be another catalyst that the capex cycle is still very healthy.
I mean, if you're right, if Google and all the rest of them come out and they actually raise their spending projections, then yeah, those people buying the semis right now are going to feel pretty good about that.
So our analysts actually raised their 2027 capex estimates to $1.1 trillion from just the big four companies. And that's this year is about 800 billion.
Wow, okay.
So that's actually about 25% above where consensus is. So if that actually comes to fruition, then I think we're talking about a huge upside for semis overall.
Well, Tom, to Kelly's point, you're one of those people, it sounds like, that took advantage of that rotation to your and your clients' benefit.
As the hyperscalers continue to invest, you've got to follow the smart money. And this is also from a government investment point to the hyperscalers. So as their spending continues, the forward-looking, potential for the memory sector in particular is going to be quite strong because memory is becoming one of the most attractive areas in the technology stack right now. And if you've got a simple explanation, you've got the GPU as the brain, that's NVIDIA. You've got high bandwidth memory, that's working memory. If you don't have a GPU performing without memory, you don't have really anything. So this whole stack that's happening, such as like a Micron, one of the global leaders in the high bandwidth memory area, the AI spending supports long-term earnings growth for this company, and they're becoming a core AI infrastructure company right now. So it's really important to kind of follow the smart money and understand that the hyperscalers are not slowing down right now with their investment.
I'm just curious what you would. I mean, also we heard people saying everyone's trying to diagnose why July was so bad. Was it a fundamental change with Chinese competition coming to the market? Was it a positioning change because all of a sudden people and hedge funds are selling big tech and things like that? Was it the Iran war? Like Brian said, we're kind of looking past that, even though it's still very much happening. But the oil price is somewhat steady, and so people don't feel like big tech is the only place they can be. They can be in the rest of the market. What do you make of the catalyst, and what does that mean for kind of once we hear from the big players and earnings, then we have to kind of look to the next thing?
Yeah, so first on oil prices, I think higher oil prices are actually a tailwind for big tech because you can't really own anything but AI. I mean, that's been the case back in April and May, and that's when all these AI stocks massively outperform the rest of the market. And number two, I think heading into the hyperscaler EPS, I think the monetization side is equally important as CapEx guidance, if not more important. So if they come out and raise their CapEx guidance, but don't really show much monetization, I actually think that's bearish for the NASDAQ overall because there's going to be a fear around overinvesting. So I think monetization is a bigger focus this earnings season, despite everything.
What would that look to be? Just kind of earnings per share, revenue? I mean, is it guidance?
Yeah, I think it's all of the above. But revenue acceleration is going to be a key measure.
Yeah, Tom, have you been happy so far with the earnings that you've seen? More to come. We know that. But the numbers that we have seen and the guidance that we have seen, does that play into your thesis?
We have. I mean, we continue to be surprised. I think the general public continues to be surprised on the upside. What you really have to focus on is what this looks like multiple quarters out. So active managers like our firm will try to look forward and where the momentum is here, since we're talking about momentum stocks. But we're not surprised at all. I mean, this is going to be one of the greatest the greatest bull markets that I think that we'll experience, and it's just because of the technological evolution that we're seeing with AI, memory expansion, the speed of chips, how things are connecting together. It's a very, very positive time to be in this current technology business
What's
cycle.
then there's always risk every day, every year, forever. What's the risk, Tom, right now?
Well, we don't see a lot of risks. We've got a positive business administration, with current administration. Earnings are very strong. The risks, you could see some geopolitical activity happening. You obviously can see a slowdown in consumer spending. You could see a hint of slowdown in CapEx spending. But for right now, in participating for the second half of the year, I think it's all systems go. You want to have that diversified portfolio, but you definitely want to own some of these names in the memory sector, the chip sector.
All right. Gentlemen, thanks. And you also, you agree that you can stay long, own it, own the chips, own the trade?
Yeah, we're bullish.
All right.
Yeah.
Gentlemen, thanks. Tom Hulick, Oh Sung Kwon, really appreciate it. Coming up, we have a lot more for you this hour. Jamie Dimon sounding a big warning, what he said that should put you on notice. Plus, how do we actually power these grand AI ambitions? And is crypto back? Price of Bitcoin, where was it? 66K at last check. S&P launching a new crypto index. All that and more after the break.
All right, welcome back. Today's bond report is not just about bonds. It is way bigger than that because borrowing costs are rising again and now back to levels that are making some big names nervous. Case in point, one JP Morgan CEO named Jamie Dimon. Listen to this from a recent interview.
I would not be a buyer, and part of it is interest rates. Inflation. I mean, even if inflation was 2%, the 10-year bond should probably be at 4.5 or 4 to 4.5, and the short rate should be at 3.25 or 3.5, and they're almost there today. So I don't understand what the upside is, even if you think inflation could go to 2%.
Yeah, they are almost at their highs. Look at this, 10-year yields. They're sniffing multi-year highs right now. The one-year high was 4.69% back in mid-May, about 2 months ago. But in January of 2025, the 10-year yield briefly bumped up against 4.8%. With so much of the AI spending story relying on debt, the question kind of is now, what level of rates shuts down the debt story and thus maybe part of the entire market story? Hopefully, you will not have to find out. But JP Dimon and JP Dimon, I just gave him a new, you know what? It's perfect. JP Dimon and others are closely watching bond yields, so we think you should be too. Let's talk more about all this with Termer Banowitz. He is Chief Investment Strategist and Innovator from Goldman Sachs Asset Management. I think JP Dimon is a really good name for him. We combine his name and his job, kind of sounding a warning about interest rates. Is he right to be worried?
Well, Brian, I think it's certainly something we need to be paying close attention to right now. Look, this was already a story if you look at the Iran situation, energy prices, all of that. But now you add into this the AI build out and the financing that's taking place, which is shifting more towards debt. You look at hyperscaler debt, we're up 200% year over year. About 20 to 25% of all debt issued in the U.S. this year has been due to AI. So we have to be paying attention to that. I think that's really important. We don't think it sounds the alarm bell on those stocks, but I definitely think, Brian, we want to be paying very close attention to how we're building portfolios.
Fair enough. Put this in plain English, right? Like we talk about mortgage rates and sort of loan rates, credit card rates all the time. You know, it's 6%, 6.5%. People are still buying some homes. Not nearly as many as they were. But if you really want a home and need a home, you might pay the 6%. You probably wouldn't pay the 10% unless home prices came way down. Do you think there is a level, Tim, on the 10-year where the AI debt story shuts off?
Brian, I don't think a lot of these companies have a plan B or another choice but to continue spending and but to keep financing. This is about playing defense just as much as it is about playing offense. So we think that story is going to continue, but it's about the cost of capital. You already have investors that are nervous about the spending, what that's doing to balance sheet quality, what that's doing to free cash flow. So you add this cost of capital on top. That's just another thing that we think is going to contribute to volatility on any news that isn't supportive of the revenue.
Defined outcome ETFs, just kind of go. So in this kind of market, single stock volatility is super high. Everyone's kind of bracing for earnings season and what's going to happen there one way or the other. What's your strategy for kind of getting through this?
Well, Kelly, I think you have to look outside of the traditional stock bond mix for diversification and for building a balanced portfolio. Defined outcome ETFs are becoming an incredibly important part of that.
What are they? How can you define the outcome? The outcome is I want it to go up and make me a lot of money.
Well, it's defined risk management on the downside. You're not relying on interest rates, bonds, correlations, any of that. You have, through an options package, you have a known level of downside protection and you have a known level of upside up to a cap. So what that does is it takes the interest rate discussion, moves it to the side. You put built-in risk management in place, regardless of what is driving equities and what's driving bonds. So that's a big part.
I don't want my upside capped, though. I don't want to.
But I'd like my downside cap.
That's where.
Can you use those defined outcome ETFs as a form of insurance? If people are listening or watching at home and they're like, well, I'm worried about debt levels and AI, but I don't want to sell stocks. Can you use those as like a hedge?
Absolutely. And actually, two of the most popular strategies in the defined outcome market this year, SFLR and QFLR. These are strategies that are designed to provide a 10% max loss over the course of a year, and they don't cap the participation on the upside.
Oh.
So you have
How do you have a capped loss and no capped gain?
You have a participation rate. So you're targeting 70 to 80% of upside gains when the S&P 500, in the case of SFLR, or QFLR in the case of the NASDAQ 100, 70 to 80% participation when they go up, while targeting that 10% max loss on the downside. Again, that's all through an options selling strategy. So short-dated call selling is used, buying puts on the downside to protect, all really important part of the strategy.
What do you think? You sold?
Yeah, I mean, I have to know more. When someone says capped loss, but no capped gain, you know, my already oversized ears perk up a little bit, right? Because you're thinking, well, that sounds good, maybe too good. So go more into this participation rate. How does that work?
Yeah, so the way that the portfolio is structured, you ladder out puts on the downside. So you're buying 10% out of the money puts on the index, on the S&P 500, the NASDAQ 100 in the case of QFLR. You own the basket of securities. So you're owning the physical S&P 500, NASDAQ 100 securities. And then really the secret sauce of the strategy is how do you fund that protection? So as part of the strategy, what we do is we sell 2-week calls on the index.
Got it.
And what we see that turns out to over the long term, what we see is it's 70 to 80% upside participation and caps those losses right around 10%.
But don't people? This is such a copycat industry. Again, that's why he was called. It was the innovators ETF. But everyone can now be a copycat.
That's why Goldman Sachs bought them.
Yeah, or they're
right.
going to launch their
Am I right?
version and do the same thing. You know, anyway, not to get into your whole like the thing, but yeah, if it's popular, I have to imagine other people will do it too.
Well, I'm sure that's going to be the case, and we've seen an explosion in assets in the industry. I think just for this reason. And again, if you look at the backdrop, Kelly, I mean, it's a difficult environment to manage portfolios in. Stock-bond correlation is very high. We have to look outside of that traditional framework. Defined outcome ETFs are a big part of that. We also think a big part of that is adding in different sectors to your portfolio that are going to help diversify away from this AI momentum trade. You know, financials, discretionary stocks, other consumer stocks that have had negative correlation to this momentum and AI trade all year long. We think that's an important part of this as well.
All right. Tim, thanks. Been great to have you here.
Great to see you.
Appreciate it. I'll let you go back to Chicago, Tim Urbanowitz.
Yeah, good luck. I had a little difficulty getting home from the Midwest yesterday. I hope you have an easier trip going that way, Tim. I should have just driven.
You should have
Wish me luck.
Driven from Milwaukee. I was at O'Hare. I was on 4 different flights.
Oh my gosh. And he's like, I got here fine.
He's like, yeah, no problem. He's probably on Air Urbanowitz. I'm on United.
Coming up, much has been said about the price of oil, but we'll get into another essential number in crude that we are monitoring closely. That information after the break.
All right, welcome back. We have, of course, have not forgotten about energy prices. Far from it. Right now, crude oil is up again, just over 2% to 85 bucks a barrel. If we look out on the curve for the futures contracts, the November contract for WTI crude also now back right around 80 bucks a barrel. The risk of re-escalation keeps rising. The Yemeni terror group Houthis now threatening to harass or block ships going in and out of the Red Sea. In fact, take a look at this. This is a map video from marine traffic by Kepler. That shows a large tanker. Okay, that's what's moving there, hauling about 2 million barrels of Saudi crude oil to China. As you can see, that tanker, which was headed out of the Red Sea, turned around and went back in. Now, ultimately, it's going to have to leave because the ship is too big to go through the Suez Canal. But that type of action is what we may be seeing because of that Houthi threat. Another key thing to watch are the levels from the Strategic Petroleum Reserve in the U.S. The SPR keeps going down, and it is now nearing that 300 million barrel level, which we bring up because some have suggested that 300 million level may be close to what they call the operational low for the SPR, meaning it gets low enough where it becomes difficult or slower or maybe even impossible to pull more oil out of the salt caves, which is what the SPR actually is. Kelly, it's kind of like, think about like a straw hitting the bottom of a glass, and you kind of got to move the straw around. No one knows exactly where that operational low level may be, if it even exists. But people have talked about it, and if you hit that 300 million barrels isn't going to matter much if you can't get to it. By the way, my newsletter this week also asked the question, what happens if all Iranian oil goes off the market? I know it's crazy, but maybe now these are the time for crazy questions. Writing it now, hopefully should be out by tomorrow night or Thursday morning. You can sign up today.
I'm thinking this afternoon, maybe. Put a little deadline on it. Just, you had some time on the plane.
I had some time. I had a lot of time in Milwaukee Airport. Not a lot. Milwaukee, I love you. You got to have more workstations, someplace to work.
Right, plug
at
in the computer.
Airport. You're not Roanoke, and I love Roanoke too, but it's like a Roanoke-style airport. It's small.
It's arguably the most important question of the entire AI build-out. Where is the compute power coming from? Hut 8 CEO Asher Ganoot will join us exclusively on that and their new AI data center deal. We'll be right back.